between Brent and WTI. We wrote about that. And then the relative underperformance of energy stocks. That's the leading indicator that tells, and I'm still confident about it. That's why if energy stocks started really outperforming, I'd get worried that maybe oil prices are going to be higher in the second half. So look, I have an easy job. I just let the market tell me what's going to happen.
I feel like you're having a good year. You feel like you're in the groove?
Yeah, I feel I'm in the groove. Exactly. Right. I feel like I'm in the groove. You know, I'm sure that'll change again. It's kind of like a golf game, you know.
Yeah, I was going to say, it feels like sports. You know, when things are going well, you can like see the ball just a little bit better, a little sharper.
You wake up and you just have that coordination, and then days when you wake up and you walk into a wall. I get it.
Financial markets feel like that sometimes.
I mean, it's true. It's sort of the days that things are lucid. The idea that the market is smart at sussing something out. I think it is telling, though, that oil stocks are down. And the idea here of what that tells you going forward about how long this is going to last. When does that pivot, right? I mean, I guess that's the key question.
Mike, it's good to see you. It always is. Thank you, sir. Great calls recently. Mike Wilson there of Morgan Stanley. Let's give you an update on stories worldwide this morning with your Bloomberg Brief. Vonnie Quinn has more. Hey, Vonnie.
Hey, John. Thank you. The longest partial government shutdown in history is a step closer to coming to an end. The House has approved the first part of a two-part plan to reopen the Department of Homeland Security. Speaker Mike Johnson is now eyeing a separate bill that would finance the parts of the department outside ICE and Border Patrol through September 30th. Shares of Ford lower in pre-market trading. Ford CFO Sherry House telling Bloomberg's Romain Bostic that rising commodity costs will weigh on earnings.
The forward curves are still holding that this Middle East situation is going to be more on the short-lived side. You know, as a result, at this point in time, we are believing that there's going to be some recovery as we start to exit Q3, as we get through Q3 and Q4.
Ford also boosting its full-year profit outlook, driven by high demand for pickups and SUVs. Amazon is considering a reboot of The Apprentice with Donald Trump Jr. as the host. The Wall Street Journal reporting discussions are in the early stages, and Amazon has not yet approached the Trump family. If the show gets made, it would appear on Amazon's Prime Video service. And that is your Bloomberg Brief. John.
Hey, Vonnie, thank you. That sounds super early, given that the family's not been approached.
No, but it sounds funny. Would you watch? I think I'd watch an episode.
I think obviously I'd tune in.
Yeah.
You know my taste in TV when I'm not at work. It's the kind of thing I'd probably tune in for.
It's currently happening at the Federal Reserve. I mean, it's still ongoing, so whatever.
Would you watch?
I think this is a marketing play for Amazon.
Bachelorette's
Good
not on
job.
at the moment on ABC.
Oh, yeah, that's what I do. I
Also,
go home, watch
Trump
Bachelorette with the family.
Trump recently went down memory lane and truthed out his high ratings of The Apprentice. So I don't know. I think he would encourage Junior to do this.
Up next on the program, an insult to the Federal Reserve.
It's highly unusual what Chair Powell did. This is a violation of all Federal Reserve norms, and it is an insult to Kevin Warsh.
Up next, we'll catch up with the former Boston Fed President Eric Rosengren, live from New York City. You're watching Bloomberg TV.
Have you ever thought about, or would you make a movie for a streaming service? Would you make a Netflix movie?
That's a great question. I mean,
I'm waiting for one where I ask and you go, that was a shitty question.
Yeah. I mean, you good at your job, bro. Like, this actually the first time anybody's ever asked me that. You know, I'm not here to say what I would and wouldn't do in the future. But the theatrical experience is one that means a great deal to me. It means a great deal to us. Mm-hmm. I feel a certain responsibility. Like if Fruitvale had happened a calendar year later, it probably would have come out on streaming. I've been fortunate enough that everything that I've written and directed has been a theatrical release. So I feel a duty to try to protect that. But that's where I'm at today.
Know how the market day started.
Find out how it finishes.
Public markets to private markets.
From the micro to the macro.
Covering retail, entertainment, the business of sports.
The supply chains, trade policy, how it all is impacting the U.S. equity market as we drive to the closing bell at 4 p.m.
A holistic approach to covering financial markets.
If it matters to your life, we're covering it. I'm Katie Greifeld.
And I'm Romaine Bostic, and this is The Close.
Live every weekday.
Only on Bloomberg. Context changes everything.
Key investors, top executives, global innovators. Join me for in-depth conversations with the biggest newsmakers on the day's top stories. Insight with Haslinda Anand, only on Bloomberg.
Bringing you up-to-the-minute political news whenever and wherever it happens. I'm Tyler Kendall in Washington, and this is Bloomberg.
Overnight, things weren't looking great. You had crude pushing 120. You'd just seen the 10 and 30-year yield stateside close at the highs of the year. And the tech story was mixed. It was pretty mixed with the likes of Meta getting slammed pretty hard. But since then, things have recovered somewhat. Equities are up by 0.4%. The Nasdaq's higher by 0.5%. In the commodity market, despite some, let's just say, not encouraging headlines coming from the Middle East, Brent is lower, not higher, down by 4%, following 8 consecutive days of gains for Brent crude. We're down to 113.58. And when you take that picture and plug it in and fold it over to what's happening right now in the bond market, yields are lower and not higher. They're down 5 or 6 basis points at the front end of the curve and down 3 looking further out on 10s.
I wonder if there's a regional bias. It seems like when trading is open in Asia and Europe, which is being much more significantly affected by some of the shortages, people feel a lot worse. And then when they come to the United States, based on all the guests that we've had, things are great. CapEx is booming. AI is going to save the world. And it feels like there's just such a different tone with the focus on earnings that people kind of look at all of the bright sides rather than everything
It's a pretty impressive stimulus program coming from 4 of the biggest companies on the planet, isn't it?
100%. You've got corporate stimulus instead of fiscal stimulus. So you've got both, frankly. So that's the reason why there's strength.
Yields down this morning, down 5 on 2s. The 2-year, 3.89. Under surveillance this morning, an insult to the Federal Reserve.
It's highly unusual what Chair Powell did. This is a violation of all Federal Reserve norms, and it is an insult to Kevin Warsh, Mickey Bowman, and Chris Waller to think that these other Republican nominees do not care about the institution of the Fed and that he alone can maintain the integrity of the Fed.
So here's the latest this morning. President Trump criticizing Jay Powell's decision to remain at the central bank after his term as chair ends, claiming he wants to stay, quote, because he can't get a job anywhere else. The former Boston Fed President Eric Rosengren writing, Powell views the legal actions against himself and others are intended to influence the vote on monetary policy. Eric joins us now for more. Eric, welcome to the program. You, of course, sir, are entitled to your opinion. Do you believe this is an insult to other members of the Federal Reserve?
I do not. I think it is a reflection of the legal attacks on both the chair and one of the other governors. And as a result, it was intended to influence monetary policy, and he's standing up for the institution. So I think it's probably not what he wanted to do. My guess is he did want to retire. I'm sure his family would like to start seeing him again. He's been working very hard for 8 years, but I think he's doing it for the institution.
Eric, with that in mind, what kind of institution do you think Kevin Warsh is inheriting here?
I think from the new chair's perspective, it's a challenging environment. First of all, we've had a bad inflationary shock with the war in Iran, and we're about to get PCE core inflation, but I expect both the total and core to be up a fair bit. It's going to be over 3% for the core PCE inflation, and that's very high relative to a 2% inflation target. So a new chair who may have been hoping to lower rates, I think is going to face a committee that clearly is not as interested in lowering rates at this time because of the inflationary shock that we've had and the fact that the Fed's missed its inflation target for the last 5 years. So I think there are a number of members that are quite concerned about what's been happening with inflation. There were 3 dissents of presidents for the language that is viewed as a bias towards easing. There was one governor, Governor Myron, who would have preferred to ease, but he's wanted to ease at every single meeting. So I think it's a very split committee, and I think that's challenging because Kevin Warsh needs to get a majority to get whatever policy he wants through. And I think there's an unusual level of dissent at this time.
Eric, were you surprised that 3 members dissented in order to move to a different type of language, symmetric risk of a rate hike or a rate cut at another meeting in the future? Or are you surprised that more people didn't get on board with a similar type of move?
A lot of people don't view dissents as being used on leaving language unchanged, since it's the language that if they found acceptable 6 weeks ago, you have to think there's a pretty significant change to dissent over not changing the language. That being said, the 3 dissents against the language, I think, have all highlighted in their speeches their concern for inflation. And I think it is significant that it's Chair Powell's last meeting as chair. And as a result, I think they're signaling to the incoming chair that as voting members, they're going to be resistant to a policy that tries to, in their view, ease in a way that isn't consistent with how the economic outcomes have been coming out.
Eric, what does a low-profile Governor Powell look like to you?
I think he comments on data and keeps his views largely to himself, but he's still a voting member. His vote's going to be recorded. I think he's going to vote the way he thinks he should vote. Obviously, it's going to be awkward for Kevin Warsh if he starts dissenting along with a number of other individuals against the policy, or if Kevin actually can't get the votes to do the actions that he wants to take. So I think it is challenging, but I don't think it's something that is that difficult to manage if he has a clear understanding of where the consensus on the committee is. I mean, he leads the committee, but he has to convince people that his views are the appropriate ones.
Eric, I think that's the important point. Can you keep a low profile if you're willing to dissent with the chair?
I mean, I think he's hoping he doesn't have to dissent, that the recommendations are consistent with the policies that the framework document and the committee has long had. But I think if, for example, there was, I don't expect this, but if there was at the first meeting, a move to try to dramatically ease, I think there would be a lot of people that would be opposed to that. There might not be the votes, including with former Chair Powell at that point. But I don't expect Kevin to do something that dramatic, and I think he can count the votes, and I think more than likely we'll see that former Chair Powell and the new chair end up voting together in most instances, if not all instances.
We'll see if that's the case. Eric, thank you, sir. Appreciate your opinion this morning. Thank you. The former Boston Fed President, Eric Rosengren, on the future of a low-profile Governor Powell.
Which hopefully means Jay Powell that doesn't have to dissent against.
Hopefully, imagine how awkward that would be.
That would be very difficult. That would be considered highly high profile in a significant way. At what point, though, we were talking about this yesterday, does Jay Powell sticking around give Kevin Warsh some cover in some ways, some credibility?
At least for now. At least for now. We'll see how this breaks. Up next, we'll catch up with Mira Pandit of JP Morgan Asset Management, Pooja Kamra of TD Securities, Jonathan Pingle of UBS. The ECB rate decision in the next hour. The third hour of Bloomberg surveillance just around the corner.
World's most powerful investors don't ring a bell. They quietly reshape entire industries. This is the money shaping the world. The Dealmaker Playbook, where power, billions of dollars change hands every day. From private equity and credit to venture capital and M&A, we bring you the inside scoop on the biggest deals and debates, plus exclusive conversations with finance's ultimate insiders. Great scoop on this. You've been reporting about an activist investor coming up and trying to shake things up. What's the latest?
We've been hearing that there was going to be an activist at some point. The question was who?
There is a convergence of technology and national security.
The United States is a big country. We're playing in the Northeast. That's an economy as big as the United Kingdom.
This is a really interesting space to watch. We're expecting more consolidation. As this is Bloomberg Deals at Bloomberg Invest, I want to talk about the broader deal and M&A environment.
This is a moment in time. We'll see how long we're here. It's far too early to call.
There is an underinvestment in what's going on in private markets because everyone's looking for additional AI cloud capacity, and it's very tough to build.
Everybody wants to get things going, and the IPO market is just one symptom of that. It is an early indicator of what we're going to see in the M&A market.
Let's go to Scarlet Food, who's taking a closer look at drone companies. With ongoing conflicts in the Middle East and Ukraine, there's renewed investor appetite for new names in the space.
Excellent reporting. I'm Danny Berger, and this is Bloomberg Deals. Every week, only on Bloomberg Television.
It's the world's second largest economy with a growing influence in global affairs. Bloomberg The China Show brings you the unmatched expertise you need to keep track of breaking news, in-depth market analysis, and the most influential newsmakers in and around China.
We need to do more to engage the market more. We're risk on. I think we caught a little sweet spot.
Massive savings right now.
It's already a different game.
Bloomberg The China Show. Weekdays around the world, right here on Bloomberg. Context changes everything.
Power Players is back to take a look under the hood of the business of Formula One.
Hi, I'm here to see Pierre Gasly.
Welcome to my workplace.
Do you feel pressure?
Massive pressure.
Is the best example that we can be very proud of the past to look after the future.
From the iconic brand setting the standard.
Oh boy.
Can you imagine Ferrari without racing?
No, and I say no, no, no.
To the newcomers forging ahead.
I grew up my whole life racing against the boys.
This global phenomenon continues to chart new territory.
This was a tennis court 8 days ago.
I can't even believe that. And the speed of the business has never moved faster.
My career might stop, but I'll still be driving some.
Probably very fast.
Yeah.
This is so exciting!
This season, we're along for the ride.
Welcome to Bloomberg This Weekend. I'm David Burr.
I'm Lisa Mateo.
And I'm Christina Raffini. We're tracking breaking news today from Wall Street to Washington.
Let's start overseas. The sector is really propelling this deal forward.
Yeah, the hope is this will open up new markets and provide some additional liquidity.
Of course, now they're going to have competitors. We got a big week coming up in politics.
Earnings season is underway. We're going to get some key reports.
Everything you need to know before the markets open on Monday.
Introducing Bloomberg This Weekend, bringing a little Bloomberg into your weekend routine.
Guys, buckle up.
Bringing you up-to-the-minute global news whenever and wherever it happens. I'm Haslida Amin in Davos, Switzerland, and this is Bloomberg.
It's all about the tech sector within the equity market. We might be a little bit overbought here. You have very strong sort of earnings fundamentals underpinning things.
Everyone is looking to make sure that this growth is still as strong as it has been.
The outlook still is optimistic.
This is Bloomberg Surveillance with Jonathan Farrow, Lisa Abramowitz, and Anne-Marie Hordern.
Live from New York City this morning. Good morning for our audience worldwide. The third hour of Bloomberg Surveillance starts right now. Your price action scores look like this. Equity futures adding to gains, up by 0.4% on the S&P. Likewise on the Nasdaq, a turnaround in the commodity market. Crude trimming some of this week's gain. We're down by 2% on WTI. Brent crude down by 3.4%. Heading into this in just a moment, an ECB rate decision some 15 minutes away after that economic data, jobless claims at 8:30 Eastern Time.
We'll see the division between Europe and the U.S. in some of the data that's coming out, as well as some of the rhetoric from the central banks. Right now, you've got European central banks that are facing off with much more of a challenge to a mandate that is singular. It isn't a dual mandate like in the United States. On one hand, they are seeing the weakness come through their economy. At the same time, inflation is that much higher as a result of oil prices. Can they hike? into a situation like this, given the fact their one mandate is inflation, but if they had a dual mandate, it would be screaming something perhaps a bit different.
It's the communication dance. You want to anchor inflation expectations, but you really don't want to hike interest rates. And I get the sense from all these central banks, particularly in Europe, the ECB and the Bank of England, that that's the situation, that's the tension that they're currently facing.
At a certain point, if you see your economy deteriorating and unemployment going up, what do you do? How do you respond? Do you change your mandate? Right now, the Bank of England voted 8-1 to hold rates where they were, but they indicated that they could be hiking materially. Does Christine Lagarde say the same thing? I'm looking for the color of her scarf to give some indication.
Is that what people do? We used to do that with Draghi and ties.
I think we need to start a scarf
brooches.
And brooches, yes.
Scarves and brooches.
Exactly what it is.
Okay, now typically I wouldn't try and mislead the audience and say, watch the news conference, it's going to be really interesting. The ECB is never really very interesting, particularly the news conference under Lagarde.
But
this one could be slightly different because of the situation they're in and the challenges they face in the Middle East.
How does she message this, given the fact that she has to signal a desire to anchor inflation expectations? But already yields are so high, number one. And number two, the data coming in weaker than expected just this morning, growth coming in weaker than expected, CPI on the margins coming in line, but a little bit higher in certain areas. It gives a sense of their conundrum.
Europe is struggling. First it was Asia, now it's Europe. They're struggling, we know, with jet fuel. Petrol prices are going up. They are more reliant on all of these imports from the Middle East. We spoke to the U.S. Energy Secretary this week, who's in Croatia. They're dubbing them Trump peace pipelines, but what they're talking about is just more LNG going to Europe. Second shock after Russia's invasion of Ukraine. Now they're doing with the Strait of Hormuz being closed.
So that's the schedule for this hour. So at 8:15, we'll get an ECB rate decision. After that news conference wraps up, it starts at 8:45. We're going to catch up with this guy. I think an important conversation on the Federal Reserve and the backdrop, the economic backdrop, given the threats we see in the oil market. Kevin Hassett, NEC Director, 9:30 Eastern Time, an extended edition of Bloomberg Surveillance right here on Bloomberg TV.
With gasoline prices near the highest levels that they've been going back a number of years, and this fear that maybe this will impede consumer spending, how does he dovetail both an argument for a Federal Reserve that's going to cut rates with an economy that is strong and delivering above average GDP growth? It is an uncomfortable message to deliver.
Looking forward to that conversation in the next hour. This hour, we'll catch up with Mira Pandit of JP Morgan Asset Management, with oil pulling back from wartime highs. Pooja Kumar of TD Securities with a rate decision looming from the ECB, and Jonathan Pingle of UBS breaking down the latest round of economic data. We begin this hour with stocks edging higher on easing oil prices. Mira Pandit of JP Morgan Asset Management writing oil at 110 to 120 for 6 months could have a 4 to 6% hit to EPS, but that would still leave us with double-digit earnings growth. Mira joins us now for more. Mira, good morning.
Good morning.
It's good to see you. Break it down. Where's that earnings growth coming from right now?
Look, if there's a war, nobody told earnings. That is one area of the economy where we haven't seen a significant decay in light of expectations. And even with some of the expectations that you just highlighted from our various equity analysts across JP Morgan, the range is still pointing to potentially double-digit growth. You started off the year with expectations for 15% year-over-year growth. That's gone up to almost 19%, 18.5%. So you've continued to see those upward revisions. Now, some of that is energy. A lot of that is tech, still being very resilient around that secular story. So we have a lot of buffer here when it comes to profits. And I think that's why even as yields rise, you're not necessarily seeing stocks react.
You alluded to it. If I strip out a couple of energy companies, a couple of tech firms, does it still look as impressive?
It looks slightly less impressive, but nonetheless, I mean, that earnings story is getting very concentrated, so we do need to be mindful of that, but it is still broadened out overall. So if you look at the overall Mag 7, that in and of itself is a concentrated story, a lot of that around semis. You take just one of those Mag 7 companies out for this quarter, and that 22% growth rate falls to about 6.5%. Which is not great news when we think about the diversity of earnings growth within the Mag 7. But if you look at the S&P 493, you're still seeing double digits there. You strip out any other semi from that 493, and you're still just right around that double-digit mark. So you do see some broader contributors here and some other different sectors that are participating. A lot of them still linked to AI, but at least now it's not AI in one or two companies. It's AI kind of permeating through the system.
Is this backward looking? Is this ignoring the oil prices that we see now? Should they persist for another couple of months?
Well, those estimates that we cited are assuming that oil prices stay at these elevated levels for 6 months' time. So it does assume a more extreme scenario. And again, even if we add a few percentage points to that, the buffer is so strong. And again, this secular growth around AI is so strong and broadening out that it will take more of a shock. And I think what's been interesting is this rolling 4 to 6 week timeline where it seemed like in the beginning, if we get to April, mid-April, and the Strait of Hormuz is still closed, we're going to be in big trouble. And that timeline keeps getting pushed out. So clearly the economy, the markets, earnings overall are a lot more resilient to oil shocks than perhaps we originally expected.
I love this comment. Just it needs a different kind of shock. What other shock do you need? You have your inflation shock, you've got your geopolitical crisis, and now you've got a potential rate shock. Could some of the moves that we're seeing in the bond market serve as perhaps a trigger to change this picture?
If we see rates move a little bit higher, and if that's because of some changes around Fed expectations, that's typically what we do see unseat the market. If all of a sudden a hike becomes a very real probability, then that is going to be a very much a troubling signal for the markets, not necessarily just where yields are, but what that signals about monetary policy. But I do still believe that from a Fed perspective, the next move is more likely to be a cut than a hike. We're in a very different situation than we were in 2022. Obviously, the starting point from inflation and the direction of travel is likely different than it was in terms of intensity back then. But you also have a consumer that's a lot weaker. The excess savings has dried up. The savings rate itself is depressed. You have a labor market that's not particularly strong, wage growth that's moderated. And when you look at expectations around inflation, the fear here is just headline feed into some of these inflation expectation measures. But you look at five-year forwards, you look at 5-year break-evens, they've increased about 15, 20 basis points since the war broke out. So a little bit of pressure there, but nothing that's running away here. I think ultimately what might happen, not only here in the US, but probably overseas if we think about Europe, is that higher headline inflation because people are spending more on gas and food starts to feed into core, and that actually keeps a bit of a lid on core because people are cutting from other areas.
But you say it could peak around 4% this summer, inflation. So how can they cut in that environment?
Well, I don't think the cut is on the table necessarily for this year. Maybe at best December, depending on how things play out, probably pushed out into 2027. But if we think about how we get to 4% back to the twos by the end of the year, probably the upper twos, well, we have a couple of different factors here. You have a bit of the flip side of energy prices that we do think will subside, maybe not all the way back down to where we started the year, but make some progress there. We're seeing that the tariffs will likely start to see a bit of that draining out further, the flip side there. We've had less immigration, so less demand to the overall economy. You continue to see rents soften, so we could very well be in a position where that inflation rate starts to come back into the 2% range, which means the Fed still has to wait and see, but it puts them in a better position by the end of the year to think about cuts for next year.
We spoke to Eric Rosengren moments ago, former Boston Fed president, about Chairman Powell staying on as a governor. What kind of institution is Kevin Warsh inheriting here when he takes over in June?
When you have Chair Powell staying on, he's certainly very much emphasized the point about the legal actions against the Fed and wanting to maintain the sanctity of that institution. I think the role he'll actually play on a day-to-day basis is a little bit more moving from your high school principal to your guidance counselor here, where he's going to try to help build some consensus and, certainly really try to protect the institution. But I do think that, look, the consensus building is an important aspect of the Fed, but maybe we had a little bit too much consensus building in the earlier part of this decade that could have helped prevent a policy error had there been a little bit more debate. So I do think that the debate element that Warsh will infuse into this committee is probably going to be a good thing when we think about the two-sided risks here.
Mira, it's good to see you. Thanks for breaking it down. Great summary. Mira Pandit there of JP Morgan Asset Management. I welcome it. We complained about it for ages. The groupthink of the Federal Reserve, the lack of groupthink in the last 24 hours was pretty welcome.
Yeah, I mean, look, this was exactly what Kevin Warsh said he wanted. Can we give a victory lap to Mira Pandit? Moving
That
from
was
principal
awesome.
to the guidance counselor. Yeah. That is an analogy that has so many wonderful ways to play it that I plan on really.
Who do you think spends more time in that office of the Federal Reserve? Got any thoughts? Don't know answer right now.
What, me?
Yeah, who would spend more time in that office seeing the guidance counselor?
Oh, among
the FOMC members.
Oh, yeah, I can. Oh,
yeah.
Mm.
Exactly.
Okay.
All right, let's get you an update on stories elsewhere this morning with your Bloomberg brief. Fonnie Quinn has more. Hey, Fonnie.
Hey, John, thank you. Stellantis shares sliding as investors look past a return to profit, questioning the sustainability of an apparent turnaround. Despite improved sales, analysts warn the numbers were padded by price cuts and a one-time €400 million tariff refund. The U.S. war in Iran has cost $25 billion so far, according to a senior Pentagon official. The cost includes spending on Operation Epic Fury, with most of it going to munitions, as well as operations, maintenance and equipment replacement. The White House expressing opposition to a plan by Anthropic to expand access to its Mythos AI model to about 70 companies and organizations. Sources telling us here at Bloomberg, officials are concerned the company lacks the compute power to guarantee security. And that is your Bloomberg Brief. John.
Hey, Vonnie, thank you. More from Vonnie a little bit later. Up next, the morning calls, plus the latest rate decision from the ECB. We'll break it down with Ollie Crook over in Frankfurt. We'll catch up with Pooja Kamrat of TD Securities in just a moment. From New York City this morning, good morning.
What is going to be the consequence for U.S. markets?
We are seeing modest gains across European equity markets.
Take a look at how we're faring when it comes to Asian markets.
Technology is embedded in every aspect of our lives.
And laying the foundation for the future.
From finance to defense, AI to entertainment.
And from the road to the stars.
Bloomberg brings you the latest stories of the people and companies pushing the tech sector to new frontiers.
And the politics that shape global tech markets.
I'm Caroline Hyde in New York.
And I'm Ed Ludlow in San Francisco.
Watch Bloomberg Tech every weekday.
Only on Bloomberg Television.
At a time when policy in Washington is driving Wall Street, we draw a distinction between the rhetoric and the action, bringing you market-moving guests and original reporting. This is Bloomberg Surveillance.
Equities doing better and better. Near session highs up by 0.5% on the S&P, the Nasdaq high by 0.6. That's the price action. Here's your morning calls. First up, JP Morgan downgrading Meta to neutral, citing concerns about the company's massive AI spending plans. That name's down by 9%. Your second call from TD Cowen raising its price target on Alphabet to $450, seeing an inflection point in its monster cloud results. That stock is up 8%. And finally, Bank of America raising its price target on Amazon, anticipating more optimism on AWS capacity returns. That stock is up by 3.5.
Just important to note that Amazon's actually the biggest winner so far this year, up 14%, as it turns to more chip manufacturing and building out some of its cloud. I remember last earnings season, we were really skeptical of Amazon because they were announcing this huge CapEx spend and they were behind, and people were saying, they're behind, they're never going to catch up. Well, guess what? They're catching up, and they're catching up fast, and they're being rewarded for it.
This is what's insulating this equity market from some of the drama elsewhere. Let's get to some of the drama elsewhere. Another central bank decision, this time from the ECB, the European Central Bank, keeping the interest rates unchanged, but some nuance here and some headlines we need to work through. So let's head over to Frankfurt at the ECB and catch up with Bloomberg's Ollie Crook for more. Good morning, Ollie.
Yeah, good morning, Jonathan. We're getting, as expected, the rate decision from the European Central Bank, leaving rates unchanged. This was never really regarded as being a live meeting for the European Central Bank. But what we're getting here from the statement, really saying that downside risks to growth have intensified, upside risks to inflation have intensified, and then they're not pre-committing to any particular rate path. That is the ECB using very, very cautious language ahead of a meeting where it's very hard to predict where inflation is going for the ECB. For the ECB, what they have done is they have said structurally here, we're looking at three basic scenarios. There's the good, there's the bad, and there's the ugly. And initially, last week, we heard from Christine Lagarde. She said that the situation in terms of inflation, where they think it's going, is between good and bad. From the data we've seen over the last couple of hours, John, we've got GDP data out of the Eurozone, a number of different countries, in addition to CPI data. Just look at what happened in France. France was supposed to grow in the first quarter by about 20 basis points. That came in absolutely flat. They were supposed to get inflation of 2.3%. We got 2.5%. That is the kind of stagflationary dynamic within some of these European economies that the UCB is going to be very, very cautious about. And we should say, they're coming at this basically in real time. I mean, we woke up this morning on the day of the ECB rate decision with Brent at $126 a barrel. So what we're going to be watching very closely a little bit later is that press conference with Christine Lagarde. I suspect she knows what all the questions are going to be to her. I doubt that she's got all the answers.
Ollie Crook, thank you. Over in Frankfurt, Ollie's going to get in that news conference for you. That news conference with President Lagarde starts in just under 30 minutes' time. This is the central bank dilemma. You can't offer much guidance. You have to take a meeting-by-meeting approach because you've got absolutely no idea what's going to happen in the Middle East, how embedded price increases might become, or how to respond when this happens. Upside risk to inflation, downside risk to growth, and on both sides, they've intensified.
And we already are seeing it in the data. Earlier this morning, we got GDP data coming out of Europe. It came in weaker than expected. We had CPI, 3% year over year, increasing steadily, given the energy shock that you're experiencing. So what I'm curious, how much did you have some sense of what instruments they're planning to use? They said they stand by ready to adjust all instruments. Are they going to start to adjust some of their language to reflect the weakness that potentially could arise?
Let's get to this conversation with Pooja Kumar of TD Securities, joining us now from London. Pooja, welcome to the programme. The ECB and the Governing Council believes they're well positioned to navigate the uncertainty. Do you think they are?
I don't think any central bank is right now. ECB did give us a proper model with 3 scenarios and how they are supposed to react. And as we previously mentioned, we are staying closer to the adverse scenario, which means that there are small second round impacts. But I think at this stage, the market is so delicate that even if ECB wants to hike rates, like even a 25 basis points means that markets move 100 basis points. So I think how she communicates is going to be very tough this time.
We've seen it in recent data, Pooja. You can see that consumer expectations over the short term for inflation have risen. The ECB is acknowledging that right now. To anchor inflation at 2% over the medium term, Pooja, do you think that will require interest rate hikes?
So, as we said, that ECB is working on a model, and whatever they told us in terms of the surveys, which is the inflation surveys as well as the PMIs, they are giving us indicators that there might be second round impacts that they cannot actually shy away from. I think for me, it's still that they would try to make, they need more data, right? We don't want to act much in terms of just one data price. I think that will be the language. But for us, it's very clear from whatever we've heard from ECB so far is that inflation is still primary. They are ready to actually keep growth secondary right now. I think they've all suffered in 2022, so they don't really want to take the risk.
Which, are you surprised that long-term yields keep going higher, even amid concerns about some sort of suppression to growth?
No, definitely it is something that we are really closely watching. And I think that's why if you see after the March central bank meetings, most of the central banks try to take a step back and try to actually soothe the market a bit. But if you just put the oil chart and a rates chart, they're actually moving just with 100% correlation right now. And that's the key thing. If you do not put a lid to oil prices, it's very hard to put that lid on the rates unless we get something more decisive from central banks that they are able, that they are able to say that this is just a supply shock and the prescription is not just to hike rates. It's not a demand-driven inflation right now.
Right now, we are seeing a bit of a bid into bonds, in particular German bonds. You are seeing prices go up, yields go in after rising to some of the highest levels that we've seen going back to 2011. Pooja, is this enough coming from the ECB? Just the suggestion of the dual risks coming up, even without moving. Is this enough for them to just kind of maintain that optionality for the foreseeable future?
I don't think that will be the case. I think as far as we know, Lagarde is concerned, she will still try to say that they are still waiting for data points. But for me, the key risk is that, yes, we have lots of data points coming into the June meeting, which is one more consumer survey, one more PMI report, and one more CPI report. And also the fact that this is the time that hawks have become much more vocal, right? So even if today's conference is kept a bit more neutral and data dependent, we'll all be conscious as to how different groups of the central bank come in next week, just given the fact that we know that this crisis is not ending anytime soon.
Pooja, what can we learn from the ECB and how they dealt with the other energy shock with Russia's invasion of Ukraine?
I think at that stage, what we learned from that time was that they managed to anchor inflation primarily because the demand shock wasn't a case in Europe. So, they just had to tackle the supply part of it. I think the situation is exactly the same when it comes to Europe right now. We did have a big German fiscal spending last year, but we can see the demand has still not moved at all. So I think in Europe, the lower wage growth, the lower growth, the lower productivity potential as compared to US and UK does suggest that that spiral effect is not going to be there in Europe. But we also know ECB is laser focused on inflation right now. So they will be possibly first to act, but they might have to reverse it just because the real economy is not exactly the same as compared to 2022.
Pooja, good to hear from you. Thanks for the reaction to the ECB decision. Pooja Kumran there of TD Securities. Yields are lower today across the curve worldwide, not just the US, but Europe as well. Crude is helping to encourage that move. Crude is pulling back from wartime highs that we hit a little bit earlier on this morning. But also I'd say this as well, it's always relative to expectations. It's difficult to out-hawk. Pretty hawkish pricing for the ECB and the Bank of England coming into these two decisions.
Yeah, buy the rumor, sell the news. At what point are we talking about that type of reaction? That said, I do think it's notable that this is enough to calm market expectations of longer-term inflation, at least in the margins. And you could say we're getting no signal whatsoever because it's all driven by oil prices. So what are we even talking about here with central banks? Ultimately, they've lost control. And they're saying, as we've lost control over the situation, we're going to step back and we're in a position to do so. And right now, you're not seeing inflation expectations run away over the long term. For now, at what point does that change, given the fact that in some places, the strength in the economy is enough to keep some of the inflationary pressure?
I think we've said it 1,000 different ways already this morning. First and foremost, they want to anchor inflation expectations. That's their job. But you can sense the reluctance to actually hike interest rates at these institutions. As for the other headlines, I've got to get to this from Meta. Meta's spending a lot of money. That's not news, you know that. This is the news. 6-part bond offering from Meta. They're kicking that debt sale off this morning. And we know what they're looking to raise. They're looking to raise as much as $25 billion from that bond sale. They are not alone.
And this is why people have said you can throw anything at this market and it will just take it. I'm looking right now at investment-grade bond spreads, the extra yield over benchmark rates that people demand to own investment-grade debt. It is 80 basis points. It is less than 1%. It has gone down through this, even with the bonanza of debt sales, not only from corporates, but also from governments, and even amid all the concerns with respect to oil prices. So you look at this and you start wondering, is there going to start being pushback by investors to CapEx plans that are filling the holes that are made by inflation, and potentially concerns about what the business model really looks like going forward?
Which market, which investors? Because right now, in the bond market, to your point, we've seen great demand for these debt offerings whenever they come from these big companies. The equity market, not impressed this morning. Meta down by close to 9%, the smallest bounce off the low this morning.
Yeah, and not necessarily impressed with the fact that they're increasing CapEx without a real plan of exactly how they're going to use it. At this point, does this continue to be a repeat of what we saw late last year, although just for Meta, while the likes of Alphabet continue to do really well?
And geopolitics really hitting Meta on two fronts. The component you talked about earlier, but also the fact that some of their subscriber growth and advertisement has been hit. What's going on when it comes to Russia and Iran, they talked about yesterday. So tough spot.
Economic data just around the corner. That data drops in about 5 minutes' time. The news conference with ECB President Christine Lagarde coming up in about 20 minutes' time. Then 1 hour from now, got to repeat this programming note, NEC Director Kevin Hassett joining us on an extended edition of Bloomberg Surveillance to accommodate that conversation following quite the announcement from Chairman Powell yesterday in the news conference. The chairman is heading to the exit. As the chairman, he's sticking around as a governor. Controversial move from the Fed chair. We'll get the reaction from the White House a little bit later this morning. Up next, the data and reaction with Jonathan Pingle of UBS.
Good morning. This is Bloomberg Daybreak Europe. I'm Lizzie Burden in London, and these are the stories that set your agenda.
Taking you from the U.S. market's close to the overnight session in Asia, we'll walk you through what you need to know to kickstart Europe's trading day. Live from our European headquarters, we bring you the day's top market-moving stories, unmatched expert analysis, and on-the-ground reporting from across the continent. Tune in to Daybreak Europe, only on Bloomberg Television. Context changes everything.
We're at the epicenter of a global realignment on a scale not seen for decades. At the intersection between markets, economics, and geopolitics, a forum for sophisticated conversation. This is Bloomberg Surveillance.
It's a multi-trillion-dollar industry. We'll show you what's happening in ETFs like no one else. ETF IQ, only on Bloomberg. Welcome to the world of decentralized finance.
Why is it that NFTs have not recovered in the same way that, say, Bitcoin has?
Bloomberg is covering all things crypto.
It's a pretty spectacular story.
The people.
This is the future. This is the 21st century economy.
The transactions.
It snapped up nearly $1 billion of Bitcoin.
And the technology.
We need to build a digital Fort Knox.
That gives people financial freedom, and that's a wonderful thing.
That's extraordinary.
We ride the wave that is Bitcoin.
Bloomberg Crypto, only on Bloomberg.
Economic data just seconds away. The price action shaping up as follows. 60 minutes away from the opening bout. The cash open just around the corner. Equity futures near session highs up by 0.6% on the S&P. On the Nasdaq 100 up by 0.8. Crude pulling back by 3% on Brent to 114, unlocking this move in the bond market. Yields down by 5 basis points on twos, 389. All of that just on the margin, helping to support risk appetite when things were getting a little bit shaky earlier on this morning. Economic data just crossing the Bloomberg. Let's break it down and cross over to Mike McKee for more. Good morning, Mike.
Good morning, John. It's dropping in fits and starts, but we've got a lot of numbers to talk about. Let's start with the inflation outlook, the inflation side of the Fed's mandate, and that is the PCE price index for the month of March, up 0.7%. That is almost double the 0.4 the months before, and it is what was expected. The core on a month-over-month basis up 0.3 as expected, down just a little bit. But that puts our numbers exactly where Jay Powell said they would be. Index for prices year over year, 3.5%, and for the core, 3.2%, significantly far away from the Fed's 2% target. Now, as part of that report, we also get income and spending. Incomes up 0.6%. I'll get the breakdown where that comes from for you a little bit later. Personal spending up 0.9%. As expected, consumers hanging in there a little bit. All of this feeds into the GDP report. GDP for the first quarter. This is the first report for the first quarter, up 2%. It was a 0.5% gain in the fourth quarter of last year. The 2% comes in lower than the 2.3% that had been expected. Personal consumption stronger, though, 1.6%, 1.4% was expected. The employment cost index is a little stronger, up 0.9% compared to 0.7 the prior quarter and 0.8 for the expectation. We'll get a breakdown on that for you in just a second, whether that's wages or sort of benefits and insurance. And then finally, we'll go to the employment side of the Fed's mandate. 189,000 is the jobless claims number. It's sort of ridiculously low here. 215,000 was the number for the prior week. On a continuing basis, 1,785,000, down from 1,808,000. So a lot of numbers out there to digest. I'll look at some of the details of those, John, but we'll see what the markets think of all of this.
You take some time, Mike. I'll come back to you in just a moment. Equity futures, just your update, was near session highs, just off those levels, still positive by 0.5%. Yields give up some of the move this morning, down by 5 to 6 basis points at the front end of the curve, now down by 4 to 5. Let's break this up and start with the labour market data. The argument that we've heard repeatedly about why you won't see price pressure take off in this economy is that the labour market simply isn't strong enough. Now, that's the consensus view on Wall Street. Does the data stand up to that argument pretty well this morning or not?
The ECI came in hotter than expected. Initial jobless claims, and maybe I'm looking at something wrong, came in at the lowest level going back to the late 60s. I'm going to go double check that, but this is how low the levels are that we're seeing in terms of initial jobless claims. So if you're looking at the fact that the labor market data on the margins is coming in hotter than expected, and the fact that jobless claims came in at, to quote Michael McKee, a ridiculously low rate, this does suggest the heat that Neil Richardson was talking about. She said this is a market that is actually re-accelerating on the heels of some of this CapEx.
Let's get to Jonathan Pingle of UBS, who's been tracking the numbers as well. Jonathan, good morning.
Morning. Thanks for
I got an email earlier on this week, and it said, love the show. But I was like, oh, here we go. And then it said, Thursday mornings, 8:30, every single time I cringe, because you all get excited about how low jobless claims are. And then there were all these questions and marks about how valid that data actually was. Is that the real deal, 189? Does that tell you much about this labour market and what's actually happening in this economy?
Yeah, I mean, I'm not quite sure how to what the witty retort to that is. But yeah, they're low, and I think it's
insurance that makes it difficult to actually get a read on whether the economy and the labour market is weak or not, based on weekly jobless claims.
Well, I mean, it is only sort of one side of the. It really is only one side of the equation. I mean, you know, if you think about if you smooth through some of the week-to-week volatility, initial claims are certainly low. They're running about 205. I'm gonna guess that's the 4-week moving average with this number. Maybe it's closer to 200. That's basically been bouncing around there since January. And if you think about it, we have had basically pretty stable, low-level layoffs. This isn't that much different than 2018, 2019 layoffs. But the question for the Fed is, hiring has come way down. I think, though, if we think about continuing claims coming in, that's a sign that, maybe hiring is kind of fine, and we're still treading water there as well. But, I think looking at the swap, this morning's data, and thinking about yesterday, thinking about the overnight news about CapEx, I mean, that really is what the really big driver, overarching theme is right now. Because, as much as, real consumption came in at 1.6, tiny bit ahead, that has slowed. I mean, if you look at the last few quarters, real spending has definitely cooled. Real disposable income has come in. Even with this ECI reading, we're still going to have year-over-year gains in nominal wage growth around 3.5%. So overall, it's still a story of we have seen the slowdown in the labor market. It's spilled over into slower income growth. But man, the CapEx is off.
It's incredible, isn't it? It's incredible, the stimulus program coming from these 4 tech companies overnight, as we've referred to it as.
Yeah, although we keep saying, okay, it's these companies and these companies alone. This paints a very different picture. The fact that personal income came in at 0.6% versus 0.3% was revised up for the prior month. The same thing goes for personal spending, 0.9%. It was revised up from 0.5% the previous month. Every single indicator here, with the one exception, a very interesting exception of GDP, coming in better than expected at a time when it's not just the hyperscalers and their CapEx. So what's behind it and how resilient can that be in the face of a consumer shock?
Jonathan, the bar for hiking got a little bit lower. Certainly not the consensus view that that's the base case for the year ahead, but the bar for hiking got a little bit lower. Do you think we're still underappreciating the potential for broad-based price pressure in this economy and the ability of this labor market to support it?
Well, I think the economists like me might be, but I think the market looks like it's pretty ready to price in hikes. I mean, when we saw the initial reaction to the oil price shock back in early March, I mean, market was pretty quick to price in like near-term hikes, which would be a remarkably fast pivot for the Fed. And yesterday, if you step back and you think about the information we got, I mean, 9 FOMC participants voted for an easing bias. One of the 9 voted for actually easing, even though they knew core inflation was 3.2% and there's upside risk from energy, right?
Yeah.
So I don't think, so that was the committee. The market, though, still looked at that and said, okay, we're going to price in more hikes. So now we've got a really flat forward curve for Fed funds futures, then it turns to hikes in early 27. So the market's kind of getting there already. I still have cuts in the forecast. So it's really like the economists like me that are actually still like saying, well, we think inflation's going to be fine in the end, blah, 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 blah.
Mike McKee has got more data for us. Mike, what do you see?
Well, we're looking at the GDP numbers, which, of course, came in as a surprise, up just 2% when the forecast was for 2.3. Right now, it looks like what it is in inventories and net exports. Inventories fell by $7.5 billion instead of adding. They are down, and trade was down significantly as well, thanks to a big drop in a big increase in imports, which subtracts. We did get a rebound in government spending from the back of the government shutdown in the fourth quarter. Non-defense government spending was up 20.3%. But the numbers that really matter, personal consumption 1.6%, the lowest since the first quarter of last year. But business non-residential fixed investment up 10.4%. Of that, equipment was 17.2% higher, and intellectual property 13% higher. So a really significant increase in business spending offsets some of the consumer weakness. Looking at the employment cost index, it is both wages and salaries and benefits. Wages and salaries up 0.8%, which is higher than the 0.7% that we saw in the fourth quarter. Benefits up 1.2%. And that's the strongest in some time. Last quarter was a 0.8%. Still looking at the rest of the numbers, but I can confirm that what Lisa told you was correct. It was September of 1969.
Wowza.
That we last saw jobless claims this low. Your explanation is as good as mine. I guess companies just sitting on their hands at the moment.
Mike McKee, thank you, sir. And of course, back then, very different population size as well. So that's an incredibly impressive number at 189. In some parts of this economy, I stress some parts, we've got boom conditions off the back of some of that capex.
We have had boom conditions, I would argue, and that's what's saving this economy from experiencing anything other than strength. The interesting aspect is this just a low hire, low fire situation, or are we breaking out right now? And that, I think, is what Neil Richardson was signaling. And the fact that wage growth is as strong as it is, are we going to hear people, economists like Jonathan Pingle, discuss about productivity and how you're starting to see that work through in this beneficial nirvana rather than, computers taking over the world?
John, you get the final word, slow and stable, low hire, low fire. Are things breaking out to the upside?
Well, I think definitely the CapEx looks very strong. I think, Mike was just talking about in terms of the GDP report. I mean, we're watching equipment spending rise almost 20% at an annualized rate. And yet consumption, 1.6, that compares to we were running over 3% annualized, through 23 and 24. So, we really have reoriented this economy towards very strong CapEx, which just by composition is going to boost productivity.
Super impressive. Jonathan Pingle there of UBS. They're the conditions that are unique to America right now that the Europeans just do not have going into this news conference with Christine Lagarde in 5 minutes' time.
If you take a look at the U.S. Economic Surprise Index versus the European Economic Surprise Index, they've diverged to one of the widest points that you've seen going back many years. And it is shocking. That is what Christine Lagarde has to address. And the reason why this market feels a little bit more imperiled when you go over to Europe.
The data in Europe, not so good. Upside risk to inflation, downside risk to growth, and those risks, according to the ECB, have intensified. That news conference just around the corner. Let's get you an update on news worldwide this morning with your Bloomberg brief. Vonnie Quinn has more. Hey, Vonnie.
Hey, John, thank you. Recapping the data we just got then, PCE inflation data coming in line with expectations at plus 0.7%, nearly double the rate of the previous month. Core PCE coming in at 0.3%, also in line with estimates. First quarter GDP up 2%. That was just under estimates, but a big rise from the previous quarter. And initial jobless claims coming in historically low at 189,000. It's a good sign, obviously, for the labour market. A pair of central bank rate decisions this morning, both the Bank of England and the ECB holding rates steady. ECB officials signalling they need more time to weigh the economic impact of the Iran war. The Bank of England signalling it could raise rates if energy disruptions continue. Another check on tech earnings. Shares of Qualcomm higher in pre-market trading. The chipmaker reporting growth in the data center market and predicting that the China phone industry would bounce back. Qualcomm also sharing that a top hyperscaler is on track to start using Qualcomm components later this year. That is your Bloomberg brief. John.
Hey, Vonnie, thank you. Thanks for this morning. Up next on the programme, the ECB President Christine Lagarde, her news conference following the latest decision from the ECB, and then later we'll catch up with the National Economic Council Director, Kevin Hassett, from New York City. You're watching Bloomberg TV.
The problem we've got as an industry is when the government overtax, and let's say they tax at 30 or 40% of net gaming revenue, what happens is it starts making it uneconomical for the regulated operators like ourselves. And then the customers land up going to the black market, and the black market don't pay tax, do whatever, and there's no customer, there's no responsible gaming, and the fiscals of these governments don't collect any money. So it's finding a balance between overtaxing and then not regulating. Anything from 15 to 25% of the net gaming revenue paid on tax is probably the right number. And when you start going above that, the metrics start becoming a bit more complicated for lots of the operators.
Middle East tensions are high.
Both sides willing to go back to the battlefield.
The narrative changes moment to moment.
Is there a ceasefire? Is there not a ceasefire? Markets are up, markets are down.
Count on Bloomberg for up-to-the-minute reporting.
Breaking news this morning.
Breaking news in the last minute.
On-the-ground perspective.
Talking to you from the bomb shelter.
This White House still pushing.
And the analysis you need to make informed decisions fast.
Clearly, nothing is final until it's well and truly final.
The really important question is whether we'll get second-round effects.
Nobody covers geopolitics like Bloomberg.
Good morning. This is Bloomberg Surveillance.
Welcome back to the opening trade.
Watch Bloomberg 10.
This is the Asia Trade.
This is Wall Street Week. Welcome to Balance of Power.
You're watching Bloomberg Deals.
Welcome to Bloomberg this weekend.
This is Bloomberg Television.
Bringing you up-to-the-minute global news whenever and wherever it happens. I'm Jemana Bersetchi in Davos, Switzerland, and this is Bloomberg.
The administration is encouraging more CapEx, and the good news is that the market is rewarding more CapEx, more investment, less consumption to get higher productivity. I think it's really important that companies continue to allocate capital in a way that leads to higher productivity.
CapEx boom. You see it in the data. That was Mike Wilson of Morgan Stanley. You see it in the price action too. Near session highs on the S&P 500, up by 0.5%, higher by 0.6 on the Nasdaq. Let's get you some single names. Some morning movers. The opening bell about 44 minutes away. Yahara has more. Hey, Yahara.
Hi, John. We start with Ford. Those shares are falling up 4.25% in the pre-market as the car maker says that rising commodity costs tied to the war are expected to hit profits by about $2 billion. That overshadowing a beat and a raise at the car maker. But even that has analysts skeptical who say that was helped by a one-time tariff benefit. Turning to Caterpillar, those shares are up in the pre-market, up 6.5% after a massive beat as this legacy industrial name known for bulldozers becomes part of the AI revolution. It's seeing massive demand for its turbines and its generators, all used to power AI data centers. And we end on Royal Caribbean, those shares also rising nearly 7% in the pre-market, even as guidance fell short due to rising fuel costs, but investors clinging on to this. Royal saying that after a dip in March and April, bookings have recovered and are running ahead of last year. John?
Yahara, thank you. Thanks for the update. Ahead of the cash open, plenty of stock movers out there, some big single name stories. In just a moment, the ECB conference, the news conference kicking off with Christine Lagarde, the ECB president, in just a second. We'll head over to that in a minute. The outlook for policy is changing even at the Federal Reserve. BNP Paribas just moments ago, we expect the Fed to stay on hold into 27. Saw the same headline coming from Mike Gapin of Morgan Stanley overnight.
You said something so interesting. We started the year expecting the ECB would have to hike rates because of the oil shock and that the U.S. would remain on hold. It's flipping. This is your question, is the rhetoric completely different from the Central Bank of Europe?
Let's head over to the ECB president to listen into this news conference after leaving interest rates on hold, but facing some real two-sided risk.
While the incoming information has been broadly consistent with our previous assessment of the inflation outlook, the upside risks to inflation and the downside risks to growth have intensified. We are committed to setting monetary policy to ensure that inflation stabilizes at our 2% target in the medium term. The war in the Middle East has led to a sharp increase in energy prices, pushing up inflation and weighing on economic sentiment. the implications of the war for medium-term inflation and economic activity will depend on the intensity, the duration of the energy price shock, and the scale of its indirect and second-round effects. The longer the war continues, and the longer energy prices remain high, the stronger is the likely impact on broader inflation and the economy. We remain well positioned to navigate the current uncertainty. The euro area entered this period of surging energy prices with inflation at around our 2% target, and the economy has shown resilience over recent quarters. Longer-term inflation expectations remain well anchored, although inflation expectations over shorter horizons have moved up significantly. We will closely monitor the situation and follow a data-dependent and meeting-by-meeting approach to determining the appropriate monetary policy stance. In particular, our interest rate decisions will be based on our assessment of the inflation outlook and the risks surrounding it in light of the incoming economic and financial data, as well as the dynamics of underlying inflation and the strength of monetary policy transmission. We are not pre-committing to a particular rate path. The decisions taken today are set out in a press release that is available on our website. And I will now outline in more details how we see the economy and inflation developing, and will then explain our assessment of financial and monetary conditions. The euro area economy was showing some momentum when the current turbulence started. Real GDP grew by 0.1% in the first quarter of 26, according to Eurostat's preliminary flash estimate. Domestic demand remains the main driver of growth, supported by a resilient labor market. However, the economic outlook is highly uncertain and will depend on how long the war in the Middle East lasts and how strongly it affects energy and other commodity markets, as well as global supply chains. The incoming information suggests that the conflict is weighing on economic activity. Surveys point to slowing growth, and consumers and businesses have become less confident about the future since the war began. Longer delivery times and rising input prices suggest supply chains are coming under pressure. Looking ahead, high energy costs are expected to continue to weigh on real incomes, making households and firms more reluctant to consume and invest. While unemployment remained close to historical lows in March at 6.2%, labor demand has cooled further. At the same time, households are still benefiting from a solid financial position, and investment should continue to be underpinned by governments spending more on defense and infrastructure, and by firms increasingly investing in new digital technologies. This favorable starting point provides some cushioning against the fallout from the war. The Governing Council highlights the urgent need to strengthen the euro area economy while maintaining sound public finances. Fiscal responses to the energy price shock should be temporary, targeted, and tailored. Reforms to enhance the euro area's growth potential and accelerate the energy transition to reduce reliance on fossil fuels are more vital than ever. Completing the Savings and Investment Union is key to funding innovation, supporting the green and digital transitions, and improving productivity. The digital euro and tokenized wholesale central bank money will enhance Europe's strategic autonomy, competitiveness, and financial integration, and will boost innovation in payments. It is thus essential to swiftly adopt the regulation on the establishment of the digital euro. Simplifying and harmonizing rules across the EU's single market will help European firms grow faster. Inflation rose to 3% in April, from 2.6% in March and 1.9% in February. The rise has been driven by surging energy prices caused by the war in the Middle East. Energy price inflation jumped to 10.9% in April after 5.1% in March. Food price inflation edged up to 2.5% in April. Inflation excluding energy and food decreased to 2.2% from 2.3% in March, reflecting a fall in services. Inflation, which declined to 3%, services inflation, which declined to 3% from 3.2% in March. Goods inflation went up to 0.8% from 0.5% in March. Indicators of underlying inflation have changed little over recent months. For now, the ECB's wage tracker and surveys on wage expectations continue to indicate easing labour cost in the course of 26. At the same time, surveys indicate an increase in other cost components and in selling price expectations. Inflation expectations have moved up significantly over shorter horizons. Most measures of longer-term inflation expectations stand at around 2%, supporting the stabilization of inflation around target in the medium term. The increase in energy prices will keep inflation well above 2% in the near term. As the period of high energy prices extends, the likely impact on broader inflation through indirect and second-round effects intensifies. We will therefore closely monitor the size and persistence of the energy price surge and how it feeds through to price and wage setting, inflation expectations, and overall economic dynamics. The risks to the growth outlook are to the downside. The war in the Middle East remains a downside risk to the euro area economy, adding to the volatile global policy environment. Prolonged disruption of the supply of energy could increase energy prices further and for longer than currently expected. These factors would erode incomes and make firms and households more reluctant to invest and spend. The drag on growth would intensify if the closure of major shipping routes were to cause acute shortages of key inputs that forced euro area firms to curtail output. The worsening of global financial market sentiment could further dampen demand. Additional frictions in international trade could exacerbate supply chain disruptions, reduce exports, and weaken consumption and investment. Other geopolitical tensions, in particular Russia's unjustified war against Ukraine, remain a major source of uncertainty. By contrast, growth could turn out to be higher if the economy proved to be more adaptable to the disruption caused by the war in the Middle East, or if the conflict were resolved more quickly than currently expected. Moreover, planned defense and infrastructure spending reforms to enhance productivity, euro area firms adopting new technologies, may drive up growth by more than expected. New trade agreements and a deeper integration of the single market could also boost growth beyond current expectations. The risks to the inflation outlook are to the upside. If energy prices were to rise by more and for longer than currently expected, euro area inflation would increase further. This could be reinforced and become more persistent if higher energy prices were to spill over by more than expected to other prices and to wages, if longer-term inflation expectations were to rise in response, or if global supply chains were disrupted more broadly. Ongoing trade tensions could also give rise to more fragmented global supply chains, curtail the supply of critical raw materials, and worsen capacity constraints in the euro area economy. By contrast, inflation could turn out to be lower if the economic effects of the war in the Middle East prove to be more short-lived than currently expected, or if indirect and second-round effects proved less pronounced. More volatile and risk-averse financial markets could weigh on demand and thereby lower inflation as well. The war in the Middle East has caused significant volatility in global financial markets. Overall, financial conditions remain tighter than before the war. The cost of issuing market-based debt rose to 3.9% in March from 3.5% in February. Bank lending rates to firms, based on data recorded prior to the war, edged down to 3.5% in February, while mortgage rates remained at 3.4%. The annual growth rate of bank lending to firms increased to 3.2% in March from 3% in February, while the growth rate of corporate bond issuance fell to 3.9% from 4.5% in February. Credit standards for loans to firms tightened in the first quarter, as reported in our latest bank lending survey for the euro area. This tightening was due to banks becoming more concerned about the economic risks faced by their customers. Demand for loans to firms decreased slightly in the first quarter, especially for fixed investment. Mortgage lending grew by 3% in March, after 3.1% in February, amid a small tightening in credit standards and unchanged demand. So, in conclusion, the Governing Council today decided to keep the three key ECB interest rates unchanged. We are committed to setting monetary policy to ensure that inflation stabilizes at our 2% target in the medium term. We will follow a data-dependent and meeting-by-meeting approach to determining the appropriate monetary policy stance. Our interest rate decisions will be based on our assessment of the inflation outlook and the risks surrounding it, in light of the incoming economic and financial data, as well as the dynamics of underlying inflation and the strength of monetary policy transmission. We are not pre-committing to a particular rate path. In any case, we stand ready to adjust all of our instruments within our mandate to ensure that inflation stabilizes sustainably at our medium-term target and to preserve the smooth functioning of monetary policy transmission. And we are now ready to take your questions.
And the first question goes to Mark Schroers of Bloomberg. Mark, please.
Yes, thank you. President Lagarde, the statement says that the upside risks to inflation and the downside risks to growth have intensified. Where does this leave the ECB, this new risk assessment leave the ECB between its baseline, its adverse and the severe scenario? And what does it mean for monetary policy ahead? And related to that, would you say that a rate hike in June, as expected by markets and most economists, is indeed the most likely outcome unless there is a quick end to the war and energy prices fall back quickly and significantly? Thank you.
I think we would all wish that there was a quick end to the war. But looking at our monetary policy and the decision that we made today, we decided to keep the three interest rates unchanged. And to address your question, I'm not going to tell you whether we are closer to the baseline, scenario 1, scenario 2, because I think that what we have debated over the course of yesterday and today with the Governing Council is where are we relative to the baseline? And the conclusion is that we are certainly moving away from the baseline. Where to exactly, at what point in between baseline and other scenarios is, I'm not sure, the most relevant assessment. We are moving away from the baseline. And what is critically important is the impact that energy prices will have. I said last time in March that it would be a question of the duration, the depth, and the propagation. And this is clearly what we need to better assess. If I was to summarize for you what we decided today, I would say that we made an informed decision on the basis of yet insufficient information. So why do I say it's an informed decision? It's because we debated at length and in depth various options. We debated the decision that we have unanimously taken today, but we also debated at length and in depth a decision to possibly hike. So that was debated amongst all governors. And I'm sure that you will meet some governors who will argue both sides, or maybe one side, of both proposals. So it was really a deeply discussed monetary policy stance, of which the outcome was a unanimous decision to leave the 3 interest rates unchanged. And I'm saying that it's an informed decision based on insufficient information. It is caused by the fact that while the hard data is broadly in line with our projection and what we discussed here back in March, but there is such uncertainty that we need to understand and revisit all of that at our next monetary policy meeting. And we believe that given the position we are in, we are saying in the monetary policy statement that we started from a good position. We were well positioned to navigate. So given that position, we believe that these 6 weeks will be the right time to assess the development, to understand in particular the outcome, possibly, of the conflict, or if there is no outcome, that in and of itself will be informative, in order to make an informed decision on verified and revisited information that we will receive in the next 6 months. That's the clearest way, I hope it was clear, that I can describe for the really good discussions that we had both yesterday and today.
Next question to Annette Weisbach of CNBC. Annette, please.
President Lagarde, thank you for taking my questions. I have a question on whether you have also discussed that the risk of a stagflationary scenario in the euro area and how that discussion went. And also in the US, they are starting to also think about shrinking the balance sheet instead of using interest rate as a monetary policy instrument. Do you look into using other instruments as well instead of just hiking to alleviate the pressure from the price pressure and also help perhaps the economy? Thank you.
Well, thank you for your 2 questions. On the first one, we take the view that the word, I mean, it's quite, how would I say, popular to talk about stagflation, and it flags a lot of anxiety and all the rest of it. I think we have determined that stagflation is the right characterization of what happened in the 70s. But from our perspective, we think that it's better to park it in the 70s, given the facts that we have at the moment. You know, it's a completely different situation. In the 70s, you had inflation continuing at a, you know, sort of sustainable and solid pace. You had very high unemployment. You had a monetary and fiscal framework that had nothing to do with what we have at the moment. So we don't apply stagflation, that flashy term, to the circumstances that we have, because we really think that it's associated with the 70s situation. On the tools, you know, we have a whole series of tools in our toolbox, but certainly from our perspective, and given the data that we have and the kind of shock that we're facing, we believe that the interest rates is still the best tool that we can use and that we have debated in the course of yesterday and today. Thank you.
Francesco Canepa of Reuters. Francesco, please.
Thank you very much. So, first question about your reaction function. Could you unpack a little the relative weight that you attach to growth and inflation in your reaction function? And
that they have enough liquidity, that they have enough capital, and that they are meeting, the purpose of that we wanted to deliver. That is that banks meet the needs and the financial needs of families, households, and corporates. You referred to private credit. Well, we are going to dedicate a full chapter of our financial stability review to private credit. It's something that is catching the eye of markets because of some liquidity issues. Private credit is a totally different animal in comparison with the banks in terms of oversight, in terms of the way that they function, and we are going to analyze interlinkages between private credit and other players as insurance companies, as the banks, and with private equity. And I think that you will have a full explanation of our approach and our assessment of the potential financial stability risks posed by the private credit in our financial stability review that is going to be published in 3 weeks.
Next question. Sorry. Next question goes to Olaf Staubeck of the Financial Times. Olaf, please.
Thanks for taking my questions. My first question is on a scenario that some economists discuss at the moment, which is basically a return to the 2011 scenario, where the ECB hiked relatively early on, then had to reverse after finding out that it basically pushed the economy into stagnation. Is this a scenario which is on the top of the Governing Council's mind, and has it been discussed? What are your thoughts on that? And my second question is also to the Vice President on cross-border banking mergers in the euro area, which has been, I think, kind of a favorite topic of the ECB in recent years. We now have a situation where the German government is quite openly opposing a potential merger. Do you have any views on those kind of actions of the German government, or what at least the position? Thanks.
Well, thank you for your first question. We, around the table of the Governing Council and the staff of the ECB and the Eurosystem, is very attentive to our history. We don't have a long history, but we are paying attention to what has been done in the past. And you might argue that we, learning from history, will want to stay away from the risk of being too early, that's your reference to 2011, and the risk of being a little bit too late, and that's what some of you would characterize for 2022. I would like to debate that forever, of course, but that's where we are. And we are going to be very attentive to the data, very attentive to the inflation expectations, very attentive to the supply chain disruptions, very looking into the depth of the wage agreements and the collective agreements that will be negotiated in the near future, attentive to selling prices. I mean, there's a whole range of data that we will be paying attention to in the next few weeks. And there will be plenty of it coming in the next few weeks to be certain that from the good position we are in, we make the right decision, because our determination is to bring inflation to 2% medium term. And that, there is an ocean of uncertainty. Things might change for the good or for the bad. But one thing is certain, we are determined to return inflation to 2% medium term. My dear Vice President.
Thank you, President. If you look at our reply, the reply of the Eurosystem to the consultation process that was launched by the European Commission a couple of weeks ago, that we published a couple of weeks ago, you will realize that the main message that is embedded in that report is that we are in favor of a single jurisdiction for the European banks with free flow of capital and liquidity. And I think that, referring to the deal that you have indicated, that you have alluded, well, I think that this principle applies very clearly.
Next question now goes to Jean-Philippe Lacour of Agence France-Presse, AFP. Jean-Philippe, please.
Thank you. Bonjour, Madame la Présidente.
Sure.
I'm wondering why in the statement there is this sentence: the Governing Council will closely monitor the situation. We were speaking about history. I remember the Trichet times when he said we are looking very closely the situation. It was a pre-signal for a soon rate step. So I'm wondering why the need to add this in the communique. What was the rationale behind this today? And on the other side, on my second question, there is a stagnation or quite a stagnation of the Eurozone economy. If the ECB were to raise its rate again, are you not in a dilemma then to change the situation from stagnation maybe to recession, because an aggressive rate hike could hamper the economy? So is it here the dilemma you have to solve? Thank you.
Well, thank you very much for your two questions. I think with all due respect to my predecessors, including my dear friend Jean-Claude, I try not to be exceedingly coded. So it's not because I add one adverb or one adjective here or there that is going to mean necessarily this or that. But, you know, on the basis of, number one, the hard data that we're getting, on the basis of the worsening of our risk assessment, you will have noted that the nice word tilted has been removed, and that we are not saying long-term versus short-term. We are looking throughout the period and consider that risk is to the downside for growth and to the upside for inflation. So on the basis of that, and in view of the uncertainty that we have around, we are bound to revisit the situation on the basis of the data, the projection, the sensitivity analysis, the updated scenarios, and then we will take a decision. I think directionally I know where we're heading, okay? But we shall see. There might be massive changes taking place. There's one element that is going to have a real impact, and that is the duration of the conflict. So I'm not suggesting that because the conflict stops tomorrow, there will be no negative supply shock and consequences. There will be, we know that, because of the infrastructure, because of the logistics, because of the time lag and all that. But it would certainly have a significant impact, in particular on the oil futures, for instance. So we are watching, okay? And we are watching out the development on the on our economy and the impact that this negative supply shock has on inflation and on the activity. We will be looking at both. I think I dealt with the stagflation because that's really something that I park in the 70s. And given the projection that we have for March, you know, 0.8% growth, followed by 1.2, followed by 1.3. I wouldn't call that stagnation, sorry. It's lower growth, granted, in 26, but we're not in stagnation, let alone recession. Now, you can imagine scenarios where we're heading towards those situations, but this is not what we're seeing for the moment. Thank you.
Now, Andres Stumpf of L'Expansion. Andres, please.
Thank you. Madame Lagarde, with the risk of boring you again.
You never bore me.
I'll have to ask again of today's decision, because I don't really get if the decision is taken in, and we are just waiting to see whether we are in the bad scenario or in the worst scenario, and even the baseline one that is bad by itself contemplates or has embedded 2 interest rate hikes. I don't really get what could the ECB be waiting for
You've been tracking the ECB news conference in Frankfurt, Germany, with Christine Lagarde, the ECB president, going through a range of issues right now in this economy. Downside risk to growth, upside risk to inflation, and clearly drifting away from the baseline. Open to a range of options, a discussion about potential rate hikes. We need to talk about two things here. On the one side, we need to talk about rate pricing, the pricing in the market already, which of course is always paramount. This market was priced pretty aggressively for rate hikes through this year for both the ECB and the Bank of England. Difficult to really meet those expectations at today's meeting. But in isolation, you've got central banks that are far more open to raising interest rates now, both across the Federal Reserve, the Bank of England, and the European Central Bank compared to where they were only several months ago. We're also getting some signs of intervention as well, which we need to talk about. Over at the Bank of Japan, this headline crossing just moments ago that Japan, according to Nikkei, conducted a yen buying operation. You will have seen the headlines from the finance ministry overnight saying that we were close, threatening to make such a move, a final warning, if you will, to the FX market, pretty much in their own words. Confirmation from Nikkei just moments ago that Japan did conduct a yen buying operation.
This came after the yen reached its weakest point versus the dollar going back to late last year, and comes along mounting pressure of how they're going to support the economy given the dual pressures of both higher oil prices and inflation, but also potentially weaker growth.
If you're just tuning in, welcome to the program. The opening bell is just seconds away. This is a special extended edition of Bloomberg Surveillance going into the cash open. Haven't done this for a while. This is nice. Equity futures firmer on the S&P 500 by 0.5%, on the Nasdaq higher by 0.7%. A little bounce on the Russell up by 1%. Encouraged by this move in crude. Brent and WTI backing away from wartime highs. 113 on Brent, 104 on WTI, and check out what this does to the bond market. Just helps to unlock this move in fixed income. Yields lower across the curve. 2's down by 6 basis points. 10's Bramo down by 5.
This comes after we saw the highest levels, particularly at the 30-year yield that we've seen in a long time at the 5% level. At what point does that act as a constraint? And this has been the conundrum. On one hand, you could say oil prices act as a constraint. On the other hand, we see the CapEx plans and we see better than expected U.S. economic data. And it points to the resilience in the underlying economy that can allow some of this inflation to persist. At what point does the Fed respond? We see the Fed get more hawkish as the ECB potentially backs away from some of the rate hikes priced in.
Let's talk about this economy. U.S. economic growth accelerating at the start of the year, fueled by solid business and consumer demand, insulating this economy from heightened geopolitical risk as the Fed remains very much on the sidelines. Joining us now to discuss is the National Economic Council Director, Kevin Hassett. Kevin, welcome back to the program, sir. Always good to catch up. We'll talk about this economy in just a moment. I think we need to follow on from the Federal Reserve and the news conference with Chairman Powell just yesterday. Stepping aside as the Fed chair, but staying on as a governor. Kevin, was anyone in the administration given a heads up ahead of time before you heard that announcement?
You know, communications with the Federal Reserve and the administration are still open when there are policy concerns, but I can't really discuss that. I could say that I'm disappointed in what Jay said, but I'm going to sort of stay out of it as we await just a couple of weeks Kevin Warsh's confirmation. I think when Kevin gets in there, it's going to really be a sea change at the Fed that we're all looking forward to.
Kevin, in the meantime, the president has articulated his disappointment like you just have. Previously, the president suggested that if the chairman stayed on beyond his time, not sure what he meant specifically by beyond his time, that he would fire him. Is the president intervening certain options to intervene?
You know, I think that in the end, our hope is that Chairman Powell understands that the Justice Department has stood down. They've just asked the Inspector General of the Fed to look into this, which is something the Inspector General is probably doing anyway. And so that I think that it's time to de-escalate and move on.
Kevin, do you think the president has sufficiently de-escalated to allow him to move on?
Well, he doesn't think so, and I think that in the end, he'll study the matter, and we hope he comes around.
The Treasury Secretary says it's an insult to the other Republican nominees on the board, the likes of Governor Waller, Mickey Bowman, people that you and I know fairly well. Do you believe it's also an insult, and does it complicate the way this particular institution will operate in the months and meetings to come?
Again, I don't want to start getting too much into having the White House argue with the Fed right now while we're waiting Kevin Warsh's confirmation, which looks like it's a lock to me. The bottom line is that Kevin Warsh is going to go in there. He's going to be new leadership. He's going to be fresh leadership. And we fully expect that that's going to help everybody see how important the independence of the Fed is. Now, as a logical matter, if you just sort of say, hey, we'd like the IG to look into something, the IG is the Federal Reserve's Inspector General. And so it's completely respectful of the independence of the Fed. We do respect the independence of the Fed. And I think that the best way to show that it's not a partisan organization is to move on.
There has been a pretty aggressive push to reduce interest rates. At the same time, this Federal Reserve is shifting towards articulating a more symmetrical reaction function. Not there yet, but getting closer to it, Kevin. Supporting that is the economic data from earlier on this morning. Do you think there is space just to wait, to see, to work out how things turn out before thinking about reducing interest rates?
Right. Well, first of all, let's talk about the economic data for a second, because it was just kind of a whole bunch of blockbuster numbers. The 2% number, actually, for me, being capital spending guy, I used to be the capital spending guy at the Fed when I was a young economist, that the thing that was amazing, as you know, is, and you highlighted, the capital spending boom. And one of the things that sort of dragged it down from a really high number was that the quality of the imports has skyrocketed. And so almost half of the imports were capital goods, which were coming in to build factories in the U.S. Typically in the past, our imports are things like consumer goods that are perishable. And so the bottom line is that it's really strong data. We got initial claims, the lowest they've been since the 1960s. We got government employment, the lowest it's been since the Second World War. We've got all these positive movements in terms of fiscal responsibility and economic growth moving forward. And so then, but we do have this temporary disruption with energy markets, which is very serious. As you mentioned, the energy prices are high, gasoline prices are high. But, my read of the academic literature on what you do when you have an oil shock like this is not that you raise rates into it, especially given how I think we're highly confident that this is going to be a temporary disruption. Futures markets agree with that as well. And so I think it would be a policy error for, this ECB or the Fed to hike rates into a temporary spike in energy prices. And their own, economic studies sort of suggest this is true, because if you look at it, what they want to do is make sure that future inflation goes back towards the target. The best forecast of future inflation is not top line inflation, but core inflation. And core inflation in the last CPI number was fine. The PCs kind of crept up a little bit, but it doesn't tell the story of the top line. And the top line is the kind of thing that I think someone could overreact to.
It might not be appropriate, Kevin, to have a rate hike at this point, but do you agree with your colleague, Treasury Secretary Scott Bessent, who came out and said it might be appropriate to stay on hold for a while as this does progress and works itself out?
Again, I am highly confident that the productivity boom is going to keep core prices under control, and that my old friend Alan Greenspan in the 90s saw that because of the computer revolution that we could have high growth and there wasn't a Phillips curve kind of thing that you needed to respond to, and he let us have 4 or 5 of the best economic years that we've seen in my lifetime. And I think that we have that opportunity again, and it would be a shame if we squandered it.
So you think that it is appropriate to currently cut rates, despite the increasing concern by some of the Fed members that we are entering a potentially inflationary moment? Do you think it's inappropriate to go to something more of a symmetric type of approach?
Well, they've been sort of saying we're leaning towards cutting, and then there was some dispute about what's going to happen at the next meeting. But I think that getting interest rates down could really supercharge the economy from where we are, but not be super inflationary. So you saw that the weak spot in the GDP report was residential investment, which was down 8%. Residential investment is kind of the most interest-sensitive thing there is. And I think that Fed policy has a chance of moving the yield curve in a way that could really help home buyers. And one of the things that I remember from the 90s is that when we want to have sort of low inflation, high growth, then one of the things that happens is you get a lot of construction, residential construction. And when you have residential construction, it has a big positive effect on GDP because you have like an empty house that has to get filled with a washer, dryer, and a TV and carpet and furniture and everything else. And that's much different than if you have like an old house where you're moving from one old house to another. And so new construction is really the thing that could lift this to 4 or 5% growth, and it's being held back by high interest rates.
What's the pathway to get there, given the fact that the longer term yield curve is seeing some of the highest rates that it has this cycle, 5% in the 30-year yesterday for the first time in a while? And frankly, a lot of people in the market think that if the interest rate were cut at the front end, that would only exacerbate the creep higher in yields at the long end. How do you see that?
Yeah, I mean, there are times when that's true, but not a time when we're in the middle of a huge positive supply shock. And so I think a little bit of movement, and Kevin Warsh, hopefully soon to be Chairman Warsh, has described how one can do that and maybe play with the balance sheet a little bit at the same time and move things in a direction that helps America's homeowners. And I think that if we could get that last little bit of the economy going on all cylinders, then we'd really be back very close to talking about the golden days.
Kevin, we have triple divot crude this morning, WTI, much higher. And actually what you're seeing across America, especially in a place like California, they've actually breached $6 a gallon when it comes to gasoline. I know the White House has some measures. They've extended the Jones Act waiver, but what else are you thinking about?
Well, we've already done a whole bunch of things, including, basically opening up the drilling that was offshore drilling in California that was shut down by the state. And that's actually, alive and pumping out barrels. The bottom line is that we're very convinced that this is, a suicidal Iranian regime that was set on really big disruptive things in the region that would be perhaps permanently harmful. And that when we had them signal in their negotiations that they were just about ready to have 11 nuclear bombs, then the president decided to take action to defend the entire Earth, for goodness sake. And so right now, the thing that I look at it in terms of the economic effects of the war is how difficult it is for Iranians right now. As if the government doesn't care about them at all. And so they're having a hyperinflation, they're running out of food, they don't have any distilled product to drive around in their cars, they're shutting down businesses, even the Persian rug dealers are shutting down. It's time for that government to just see that they shouldn't aspire to have a nuclear weapon, and if they just give that up, then we can go back to having normal relations, one could hope.
Right, but what could this government do to shield Americans from higher gasoline prices? Are things like an export ban on the table?
No, what we've done is we've, as you know, we've done the Jones Act. We've opened up drilling in California. We've, pursued changing the ethanol standards so that the corn ethanol can be used more in the summer. We've taken every single step that we can, and we understand that it would have been a lot worse if we hadn't done that. But the fact is that our expectation is that things are going to get better very, very quickly if we could just get the Iranians to finish the negotiations and realize that it's in the interest of their own people to stop things that could turn into serious hunger events and so on.
Kevin, unfortunately, and you and I are probably in agreement here, unfortunately they've got a track record of doing a lot of things that aren't in the interest of their own people. In the meantime, there seems to be a preference to maintain the blockade and put the squeeze on them. How close are we to them breaching storage capacity, so to speak? What's our understanding of that? Do we have a decent gauge of where things are at inside the country?
It's a well-to-well thing. But the basic idea is that if you shut down a well, then the pressure can build, and then the oil can kind of squirt everywhere. And then when you open the well up again, you get a lot less oil out of the well. That's the sort of theory of what could happen. And it's certainly possible, because they're running out of storage, that they're going to have to shut in wells. The one thing I can say is that their production went from 5 million barrels a day to 1 million barrels a day because of President Trump's policies in the previous term, when he really put in tough sanctions on Iran to try to stop the nuclear program. And after Joe Biden came in, he just stopped the sanctions, and the energy production went back up to 5 million barrels a day over a couple of years. And so the Iranians, it took them a couple of years to get things fixed, probably with new wells and so on, because it can harm wells. But we have an experience of them being shut almost down to nothing and then getting back up.
Kevin, are partners stepping up to help? We're just hearing from the president here out on social media, so I'm sure this is the first time you're hearing of it. I'll read it for you. The Chancellor of Germany should spend more time on ending the war with Russia and Ukraine and fixing its broken country, especially immigration and energy, and less time on interfering with those that are getting rid of the Iranian nuclear threat, thereby making the world, including Germany, a safer place. I believe the German Chancellor earlier this week suggested that the president was being humiliated by the Iranians. Just what is the relationship like, Kevin, with our European partners at the moment?
I think that the European partners are feeling stress because their very unwise energy policies have exposed them much more to energy shocks from the Middle East. And it looks like the German chancellor is losing his cool a little bit. And I would suggest that, he take a deep breath and recognize that the best way for Europe to get its economy back on track is to, help us resolve this problem. And then also examine their own policies, which are so anti-free market that their economies are, happy when they get 1% growth. I think Germany's a great country. I lived there for a time. And I think there's a heck of a lot of potential for that country, but they sure aren't achieving it right now. And it's not just because of oil.
Kevin Hassett, we appreciate your time, sir. Thanks for making time for us this morning. Thank you very much, as always. The NEC Director, Kevin Hassett, there on the economy and the situation with the Federal Reserve. Just a note on the Federal Reserve. Resisting the temptation to turn up the heat and have a back and forth with the chairman of the Federal Reserve, Jay Powell. They clearly want to open the door for him to head to the exit.
They also want confirmation, a clean confirmation of Kevin Warsh to get him in before anything else. So right now, the White House is putting a clamp down on any kind of heating tit for tat between them and Jerome Powell, hoping that it will resolve itself in the intermediary. Really interesting, though. That is the time frame. They want the confirmation first, and then maybe the gloves come off.
Interesting note to finish the conversation on the difference between Europe and the United States right now. Of course, they feel the squeeze over in Europe. Of course, they're stressed. They have GDP running close to zero. And it could be zero if this continues. You can see the stress and the tension of the ECB news conference over the last 60 minutes or so. There is a capex boom driving this equity market and insulating this economy stateside that others just don't have. Europe just doesn't have.
Well, if you think about Europe versus the U.S., and this is a reason why you're seeing better economic performance and surprises in the U.S. than Europe, not only does it have the capex boom of technology, it's also an oil producer and actually almost a net oil exporter for the first time. Well, Europe has neither, right? It doesn't have the tech boom and it doesn't have the energy reserves in its own place. So how do you then get yourself above this? This is what we heard Christine Lagarde dealing with, and this is the reason why you're seeing the economic data diverge.
Europe is struggling, which is why the president also wants Europe to step up, to join them when it comes to trying to reopen the Strait of Hormuz. The Wall Street Journal overnight was talking about how a diplomatic cable was sent from the State Department to embassies telling their officials to press these foreign governments to help them in a maritime freedom construct to try to reopen up the Strait of Hormuz. But to Lisa's point, we are a net energy exporter. We will feel some of it, but we're much more insulated. Europe is not.
Fun morning. I'm not suggesting we do this every morning, but fun morning, right?
Oh, I think it was great. I mean, honestly, it's been such an active, interesting week. I could just stay here the rest of the day.
One more day to go, Bramo. One more day. Keep it together, okay?
Oh, I am. I'm doing great.
Coming up tomorrow, Ajay Rajajaksha of Barclays, Tom Forday of Maxim Group, Victoria Fernandez of Crossmark, and the NASA administrator, Jared Isaacman. Looking forward to that conversation from New York City. Thank you very much for choosing Bloomberg TV. This was Bloomberg Surveillance.
Power Players is back to take a look under the hood of the business of Formula One.
Hi, I'm here to see Pierre Gasly.
Welcome to my workplace.
Do you feel pressure?
Massive pressure.
Ferrari is the best example that we can be very proud of the past to look after the future.
From the iconic brand setting the standard.
Oh boy.
Can you imagine Ferrari without racing?
No, and I say no, no, no.
To the newcomers forging ahead.
I grew up my whole life racing against the boys.
This global phenomenon continues to chart new territory.
This was a tennis court 8 days ago.
I can't even believe that.
And the speed of the business has never moved faster.
My career might stop. I'll still be driving some.
Probably very fast.
Yeah.
This is so exciting!
This season, we're along for the ride.
Every weekday, Bloomberg puts the spotlight on a different aspect of global finance. Flows, funds, and the forces shaping markets on ETF IQ. The future of money with Bloomberg Crypto. The players behind major transactions on Bloomberg Deals. The stories informing finance with Bloomberg Markets. And rates, risk, and the cost of capital on Bloomberg Real Yield. A different topic every weekday, only on Bloomberg Television.
Get your fixed income fix. Watch Bloomberg Real Yield around the world right here on Bloomberg. Context changes everything.
Astonishing day for US technology.
Shaping the region's technology ecosystem.
Asia's biggest tech news and innovation.
Middle East tensions are high.
Both sides willing to go back to the battlefield.
The narrative changes moment to moment.
Is there a ceasefire? Is there not a ceasefire? Markets are up, markets are down.
Count on Bloomberg for up-to-the-minute reporting.
Breaking news this morning.
Breaking news in the last few minutes.
On-the-ground perspective.
Talking to you from the bomb shelter.
This White House still pushing.
And the analysis you need to make informed decisions fast.
Clearly, nothing is final until it's well and truly final.
The really important question is whether we'll get second round of
Nobody covers geopolitics like Bloomberg.
Hello from Bloomberg House. This is a special edition of Open Interest. I'm Danny Berger. We are in the heart of the Miami Design District as Formula One takes over the city. Matt Miller, he's close by, but currently preparing to kick off the day of high-profile interviews that will include the CEO of the Audi Revolut F1 team, and I'll also be sitting down with Tom Bravo, managing partner Orlando Bravo, and in just minutes from now, Scott Rubner from Citadel Securities. But first, let's check on stocks after a day of heavy news flow, including the mega earnings session. Meta and Alphabet are each adding $10 billion to their AI spend. Amazon and Microsoft are seeing major growth in cloud sales. Mag 7 AI CapEx in 2026 is on pace to top $700 billion. Only Alphabet, though, gaining. Meta down as much as 9%. At one point was down 10% at the open. Let's also look across assets, though, because oil has touched its wartime high. Iran's supreme leader vowed to dismantle the U.S. presence in the Strait of Hormuz and guard its nuclear capabilities like its border. Also reports coming from Axios that Trump is maybe considering other military actions. And add on top of all of that, a Fed rate decision yesterday where you did have some dissent towards the hawkish direction. But still, it's a market dominated by the Mag 7 earnings late yesterday. Joining me here to discuss that and much more, I'm pleased to say it's Citadel Securities Head of Equity and Equity Derivatives Strategy, Scott Rubner. Scott, thank you so much for joining.
Good morning.
Lovely to be in your town, beautiful, sunny Miami.
Thank you.
So, okay, first of all, I know you called this the Super Bowl of earnings week, and that it was. I feel like it was like a giant middle finger to traders for all of these companies to decide within 80 seconds of each other to report. Just how difficult is this for the market to absorb these big consequential earnings coming from these companies that are uplifting CapEx and kind of the entire economy of the United States?
Yeah, so we are not seeing any decline in spend and demand for AI. As we mentioned, it was the Super Bowl of earnings last night. By the end of the week, 66% of the market cap of S&P will have reported Q1 earnings. And from us, it's a very positive sign on the tech industry. And the way that you invest in the U.S. equity market is one of high quality, high demand, high free cash flow, and it's unlike any world in the globe.
So if these are so attractive, why do we see swings like Meta down 9.5% on the day after it reports?
Yeah, so I would say that if I look at the run up into earnings and I take the semiconductor index, it rallied 19% over 19 days. And I think we're not seeing any real pullback in these names, despite the move in Meta. But I would just say when I look at equity futures today hitting a new all-time high, there's a big shift from what was a technical driver in March to one that is a fundamental driver in April.
How do you distinguish that? Because I could, for example, look at that OpenAI news on the Wall Street Journal that perhaps they're not hitting their internal targets, and you get tech that sells off. And it wasn't just tech, it was like a momentum basket does really poorly. So on days like that, when it's selling, how much of that is fundamentals in the driver's seat and how much of that is just taking some of the air out of the momentum trade?
I think the article happened to hit at an all-time high point in the momentum factor. I think that baskets are trading in the market more than ever before. So it was orderly to me. It was a buying opportunity. It was one that was factor driven, but it didn't change any views on the fundamental side.
Is it fair to say, though, that a lot of these pullbacks are just buying opportunities, especially for these quality big cap tech companies?
From our retail clients, we're really seeing that dynamic. So if I look at on Monday, we had our retail demand in the 94th percentile over the last 5 years. So I think when there is a sell-off, right now it's a buying opportunity, especially in the U.S. mega cap tech stocks.
Has that been the case through this volatility, through the war in Iran? Are we seeing retail still buying the dip?
So I think that's a great question. Where you had retail really playing defense around tax day, April 15th was a big day where they were playing more defense and less offense. We've seen this completely change. So retail had a very good trading year in 2025. We execute between 35 and 40% of all retail flow. So we see this with data-driven insights. But now retail moved back into the driver's seat after especially One Big Beautiful Bill Act and tax refund checks hitting the accounts. I think we're seeing a return from retail. It's no longer meme stock trading, but it's one that is, they're driving the price action.
What does that mean for supply demand? And you're always really brilliant here, because if you have retail buybacks coming back, hedge funds still participating, is there a real imbalance that could push stocks higher?
There's a supply and demand mismatch right now, Danny. So when I look at corporate earnings, given that you mentioned it, so next week starts the start of the buyback window for corporates. If I look at U.S. corporates, they authorized $544 billion year to date, over $1 trillion worth of repurchases this year. It'll be the largest year on record. So stock certificates are now a rare commodity again. And, by my calculation, I see about $5 billion worth of corporate demand every day during the open window, which negates some sort of the selling pressure. So U.S. corporates, again, are the biggest buyer of the stock market, and U.S. corporate CEOs are showing strength in their views on the market.
If I just took everything you just said, it's very easy to be incredibly bullish on this market, and it's indeed not just easy, but logical. But then another part of my brain, Scott, goes to oil trading at 4-year highs, yields moving higher, 30-year yields surpassing 5%, and at the same time, the VIX is 18. It does feel like a bit of a disconnect. Is that fair? Is there some irrational exuberance in markets that other macro cross assets aren't really reflecting as well?
Yeah, so the way that I view both cross asset volatility and oil prices, you mentioned the 30-year bond hitting 5%. So there's a lot of reasons to run this wall of worry, especially on the software side and private credit. But when I look at the participation of who is trading the equity market, it's almost a macroeconomic indicator. When I think about the bottom 50 percentile of wealth demographics, we've seen equity exposure ramp by 300% since 2022. So it's almost a resilient consumer, one that grew up on the trading apps, trading all of the exchanges and after hours type of volumes, that to me is, as long as there's no displacements from AI in the jobs world, it's something that we're really bullish on.
Can I tell you why I love that? Because we look at a lot of things like University of Michigan and sentiment looks really poor.
Yep.
So I feel like this is a better way to kind of gauge, because it's a consumer that keeps spending and clearly continues to buy stocks too.
We actually have our own sentiment indicator that we started publishing. Citadel Securities executes between around 24% of the U.S. exchange on a daily basis. And what I find with our indicators is we're actually real-time back testing this on data. And our indicators are a lot more euphoric than what the sentiment indicators that we've seen.
Did they take any hit with higher oil prices and the war in Iran?
I would say that it was a quick mechanical-led sell-off in March. It was very robotic on degrossing portfolios among institutional investors, but our retail clients were actually, slowly entering into the market, and we've rallied pretty aggressively since then.
By the way, since degrossing, have institutions regrossed up? Where do they stand in exposure?
Yeah, that's a good question. So hedge funds gross exposure, which is basically longs plus shorts, if I look at back to March, was at an all-time highs led by the shorts. And if I look at net exposure, which is longs minus shorts, that was at lifetime lows. So you had this dramatic need to hedge based on rules. So it was shorting ETFs, it was shorting index futures, it was buying put options. That all happened in March. The market healed dramatically since then. Hedge funds are slowly participating on the way up, but retail's really the price setter in the market.
By the way, what difference does it make, I guess both for institutions and for retail, to have these huge IPOs coming to market? So much has already been said about the concentration in tech. And now we're about to get $800, $900 billion companies, even more when it comes to SpaceX. What difference does that make to have such a change in the composition of this equity market?
So when you think about the S&P 500, if you allocate $1 into the SPY ETF, 35 cents goes into the Mag 7, 40 cents goes into the top 10 stocks. When you think of what percentage of the U.S. equity market is AI or AI adjacent, it's 45 cents of every dollar. So when I see the distribution, I find the U.S. market remains very robust in terms of rebalancing. So there will be some of the big names have to be sold to make room for new IPOs. We've done a number of work on this, but it's not a net negative. It's something that is based on all of these passive flows that go into the U.S. market, based on target date strategies that make all companies higher in a market capitalization basis. So when they enter the market and go into these big indices, it's actually quite bullish for the U.S. versus the rest of the world.
Interesting. So if you were running a portfolio and you'd want to kind of prepare for this, like what do you advise?
It's one that naturally the biggest weights need to be sold to make room for these new IPOs. The interesting dynamic is that retail will actually get a decent slug of the IPO allocation. And this is a new phenomenon in 2026, something that we're actually quite...
Years, prices are 3.5% higher than they were a year ago. One reason why, the sharp increase in gas prices amid the war in Iran. AAA says the national average of $4.23 a gallon's the highest in 4 years. That led to protests at places in Michigan. Jill Murphy was taking part.
I've known a few people already saying they don't know how they're going to get to work because it's so expensive right now.
Not all the economic news was bad. The economy grew at a 2% pace in the first quarter, and weekly jobless claims fell by 26,000, dipping below 200,000. But what's ahead is murky, as Iran's supreme leader in a new message today said Iran would not give up its nuclear program, going against President Trump's Oval Office message Wednesday.
They've come a long way. The question is whether or not they're going to go far enough. So at this moment, there will never be a deal unless they agree that there will be no nuclear weapons.
And that means the Strait of Hormuz remains closed. Cole Allen's due in federal court for a pretrial detention hearing. He's the man accused of trying to run into the White House Correspondents' Dinner while armed in order to harm President Trump and members of his administration. The governor of Maine, Janet Mills, is dropping her Senate bid just over a month before the June 9th Democratic primary against her opponent, oyster farmer Graham Plattner. Meanwhile, Louisiana's governor reportedly may delay next month's primary to redraw the voting map after Wednesday's Supreme Court decision.
Republicans, including Louisiana's governor, cheering the ruling.
I think this whole race baiting race issue on the redistricting has been put to bed finally once and for all.
Democrats say after this ruling, only one of Louisiana's 6 congressional districts will be majority black.
That's ABC's Jacqueline Lee. You're listening to ABC News. In the House,
on this vote, the yeas are 235, the nays are 191. The bill is passed. Without
a 3-year reauthorization of the FISA bill, which expands criminal penalties for abuses of that controversial program that allows for domestic spy powers. This establishes a new requirement for the FBI to provide written statements for searches related to American information that's collected. It's not clear if this will pass the Senate. A former employee at a Dallas area Chick-fil-A is charged with stealing $80,000 from his former employer and allegedly using mac and cheese to do it. ABC's Jim Ryan explains.
Investigators say that after he was fired from Chick-fil-A last November, Keyshawn Jones would repeatedly come back as a customer and then step behind the counter when no one was watching, enter food orders on the register, then refund them to his personal credit card. He was finally caught last week after police say he rang up 800 orders of mac and cheese.
And a Georgia man was sentenced to more than 3 years in prison for embezzling almost $4 million from his employer. That's the NBA's Atlanta Hawks. Lester T. Jones Jr. had pled guilty to wire fraud in December. Federal prosecutors said he obtained his money by submitting dozens of fraudulent expense reports and charging personal expenses to corporate credit cards. And Walmart's trying to bolster its beauty aisle by adding specialists who can make recommendations and suggestions to shoppers in stores. I'm Brian Clark, ABC News.
This is Bloomberg Intelligence with Scarlett Fu and Paul Sweeney.
How do you think the Fed is looking at tariffs, the uncertainty of tariffs?
Let's take a look at the sectors and how they performed.
A lot of investors getting whipsawed every day by news events.
Breaking market headlines and corporate news from across the globe.
Could we see a market disruption, a market event?
Are people just too exuberant out there?
You see some so-called low-quality stocks driving this short-term rally.
Bloomberg Intelligence with Scarlett Fu and Paul Sweeney on Bloomberg Radio, Originals, and the Bloomberg Business app.
Good Thursday morning from the Bloomberg Interactive Broker Studio in New York City. We are streaming live on YouTube, streaming live on Bloomberg.com as well. Red and green on the screen here today. Lots of earnings. Big tech earning night last night. We got Apple after the close tonight. We're going to start off strong. Mandeep Singh, Global Tech Research Director for Bloomberg Intelligence. We'll break down what we heard last night from the big cap names here. Mike McGlone, Bloomberg Intelligence, Senior Commodity Strategist. Big swings in oil. We're up last night about $126 a barrel. We're now at $114 on Brent. Big swings. We'll talk to Mr. McGlone about that. Ann Maletti, head of equity investments at Allspring Global Investments, will join us to talk to us about the markets. Anurag Rana, Bloomberg Intelligence senior technology analyst, he'll talk to us about some of these tech names and what to expect from Apple after the close. We got a lot of earnings stuff coming up. It is Scarlett Fu. It is Paul Sweeney live here in our Bloomberg Interactive Broker Studio. This is the Bloomberg Intelligence Show. Let's get a Bloomberg Business Flash right now with Alexis Christophers.
All right, thanks very much, Paul. And this Bloomberg Business Flash is brought to you by IBKR. Will the Fed raise rates by 25 basis points in June 2026? Trade your predictions alongside your stocks and options at ibkr.com/predictions. Last trading day is June 17th. We've got a mixed market right now. Dow Jones Industrial Average racing ahead more than 400 points, but the S&P 500 up just about 7, and the Nasdaq Composite is down 46, thanks in large part to Meta. Shares there are plunging today on rising concerns over its AI spending spree. We've also got shares of Eli Lilly up about 8% after a blowout earnings report. Merck is lower despite stronger than expected quarterly results. It has repeatedly assured investors that it's working on ways to offset the impact of its key cancer drug Keytruda coming off patent shortly. And shares of Bristol Myers Squibb up 3.5% after quarterly results topped estimates on new drugs ahead of the results of a key trial result. And Brent crude coming off that 4-year high. It was above $126 a barrel, now more like $114 a barrel. West Texas Intermediate at 105.42 the barrel. Bloomberg Dollar Spot Index 11.96 even, and the 10-year yield 4.39%. That's your Bloomberg Business Flash. Paul and Scarlett.
All right, Alexis, thank you so much. We appreciate that. Scarlett Fu and Paul Sweeney live here in our Bloomberg Interactive Broker Studio in New York City. We are streaming live on YouTube and at Bloomberg.com as well. As Scarlett, Alexis was just reporting, kind of red and green on the screen here this morning, but let's take a look at some of these stocks on the move today. We can do that with Bloomberg Bailey Lipschultz. Bailey, what are you looking at?
Yeah, looking at least one of the big Mag 7 names in Alphabet, or Google, as I like to call it, ticker GOOGL, right now up more than 6%, trading at a record high. This came after beating expectations in the first quarter. The big things that stood out, according to Wall Street analysts, search was very strong. AI kind of delivering for their search unit, as well as cloud being a standout for the quarter. Year-over-year growth on the cloud accelerating to 63%, and then looking at their backlog, nearly doubling sequentially to over $460 billion. So really firing on all cylinders, and we're sifting through, as you mentioned, Paul, a number of big tech earnings, but definitely Alphabet standing out so far this morning.
Yeah, the big winner of the 4 Mag 7 names that did report. Outside of the Mag 7 names, you also had Qualcomm reporting.
Yeah, Qualcomm reporting, ticker QCOM right now up more than 12%. That's the biggest gain since April, but also really trading at the highest level in more than 3.5 months. This came after partly the company beating expectations, but also disclosing that they're making headway in the lucrative data center market and also leaning into China. The big thing to keep in mind with Qualcomm is there's been a lot of pressure and back and forth on the smartphone sector and what that means with the iPhone as well as some of the Android devices, but the company leaning into data centers is certainly something that kind of perked the ears or caught people's, eyes and ears when they were talking about the potential demand there. And obviously we're talking about a memory crunch with so many of these AI data centers being built out. So Qualcomm kind of shifting away to produce fewer smartphones and leading that to be a big gainer on the day. But again, all things considered, not really standing out against most of its peers.
Pershing Square went public yesterday. Kind of a rough first day of trading, but bouncing back a little bit today.
Rough first day of trading, and we're looking right now at Pershing Square proper, ticker PS. This is the management company, not the closed-end fund, though they're both rallying. But Pershing Square, ticker PS, right now up 17%, trading around $28. So that is the asset management company. And the gains for both the closed-end fund and the asset manager came after Ackman took to X, saying that he bought 500,000 shares in the open market of the closed-end fund and 800,000 shares of the management fund yesterday in the open market. Our math means that he spent close to $40 million on those purchases. But again, this is kind of an interesting deal. So if you're investing in PS, you're betting on the actual company. That'll be compared to some of the other asset managers. If you're betting on PS US, you're essentially getting exposure to his underlying fund, if you will.
Is that unusual for him to jump in and support the shares like that in the first trading day?
I don't think we normally would see that. I think most people would say that most insiders aren't forced to buy. And obviously it caused a lot of headlines yesterday. The closed-end fund trading down 18%. But you have to keep in mind that because of the bonus share, as they framed it, of the management company, the losses were closer to 9%. But that's still not a really what you want to see in a public listing, public debut. You normally want to see a bigger pop and not a 9% net loss for people who bought and held on.
You do the math. You did the math.
Do the math. Someone's got to do it. Not everyone is doing it, but yeah. So I mean, the other interesting thing is Pershing proper, right around $25 is where they were valued at when they were valued at $10 billion in the private deal a few years ago. So $28 right now is where it's trading. So a bit of a premium to that last round. Okay. But again, when your head of the company has to take to buying in the open market and promoting it and talking about doing a spaces on Twitter with the CIO, right, it's normally not what you would see when companies like this go public.
Okay, so he's got 2 companies listed on the New York Stock Exchange and 1 in the UK. Is that right?
Yeah, he's got. So PSUS is the U.S. closed-end fund that is going to mirror the European listed closed-end fund. The European closed-end fund trades at about a 30% discount to net asset value. After yesterday's close, the U.S. listed one was, call it 17-ish, and that was kind of his whole pitch was you're essentially buying things at a discount, and in their view, this is something that should trade in the long run at a premium, but that doesn't happen normally.
All right, Bailey, thanks so much. Appreciate that. Bailey Lipscomb, senior equities reporter for Bloomberg News here. Yesterday, after the close, a lot of the big tech names reporting, and it's the market's kind of trying to suss out some winners and losers. Google, I guess, on the plus side. Meta
yeah,
on
not
the
so much.
downside. So let's check in with Mandeep Singh. He does all the technology stuff for Bloomberg Intelligence. Mandeep, Meta trading down 10%. Let's start there. What's the market reacting to?
Well, the market is reacting to the capex increase when they don't have much to show, unlike their hyperscale cloud peers who clearly have seen that top line benefit. I mean, Meta's top line growth is very strong. 33% at the $200 billion run rate is very impressive. It's just that when you look for that extra line item where AI is categorized separately, they don't have much to show for it. And right now, the growth in AI is around coding agents. So Meta has a model, they've released it, but it's not something that specializes in coding agents. They are targeting more of the personalized super intelligence, personal assistant, that kind of a use case. And they just haven't given us enough in terms of a timeline when they will start monetizing that use case. So all in all, CapEx increase tied to memory components, not really tied to additional capacity, but it was enough to cause this, 10% drawdown in the stock. But overall, fundamentals were still strong when they reported the quarter for their core business.
Yeah, I guess investors don't like it to hear when the CEO is saying there isn't a very precise plan for how each AI product will be cultivated. It sounds too generic for their liking. We should mention as well, Meta is now looking to sell up to $25 billion in investment-grade bonds to kind of fund out all those spending plans they have. Speaking of spending plans, Alphabet is increasing its spending plans by, I think, about another $10 billion.
Yeah, and look, when you compare the magnitude of increases from Microsoft, which raised almost, by $35-40 billion their CapEx, Meta raised it by over almost $20 billion. And that was mostly attributed to memory price increases. So the question is, why was Alphabet increased not of the same magnitude? Yes, they raised, but it was a very slight increase. And that kind of goes to show that Alphabet, out of all the hyperscalers, has the best CapEx efficiency. They are able to use their compute across their apps, whether it's search, YouTube. Also, the cloud business is growing at the fastest rate compared to other hyperscalers. So that CapEx efficiency is what's driving a lot of the margin upside, and it's reflected, in their numbers and guidance. So even though it was a beat and raise from everyone, Alphabet's beat and raise was the most impressive, and hence the stock reaction.
Mandeep, where do you think we are in this hyper investment phase for AI? Are we going to do this for another quarter or two, or is this going to be a couple, 3 years?
I mean, this definitely has the makings of a super cycle. Almost everyone, on the call yesterday from the management teams talked about how, demand far exceeds supply. And look, the compute usage is showing up in the cloud numbers. When you think about even Amazon, $150 billion business growing at 28%. And Google, $80 billion cloud business growing at 63%. So you're seeing that ROI with these AI investments, and there's no reason to curtail that investment when you're seeing this kind of a top line lift. The only thing is, component pricing, memory notably, is eating up a lot of this CapEx increase. But that's just, again, a function of demand being much higher than what these companies can supply in terms of components.
So Mandeep, looking ahead to Apple this afternoon, is there an AI story to tell here, or is it so basically Apple hasn't done very much and needs to do more?
It needs to do more, and that's where the top line growth will pale in comparison to, the four companies that reported last night, simply because iPhone refresh cannot be as big of a driver as data center, monetization is for all of these companies. And yes, Meta is not there yet, but that's the promise, that if you're investing in AI data centers, you have that multi-year driver. In the case of Apple, they will be impacted by memory prices, but you're just not going to get that kind of lift from either the unit shipment sales or the services business. And that's where the new CEO, I think he really needs to lay out a strategy around AI data centers. My guess is they'll talk about Google Gemini partnership and not so much about their own investment. But I think they will be pressed on that particular aspect, what their plan is, in terms of near to medium term.
All right, Mandeep, thanks so much. Appreciate it. Mandeep Singh, Global Tech Research Head for Bloomberg Intelligence. We're going to check in with Mandeep's partner, Anurag Rana. Later on in this hour, we'll be able to break down Amazon and Microsoft with Anurag and also get his preview of what to expect from Apple. So a busy time for tech investors to figure out, try to learn a little bit more about this AI investment theme, the opportunity, the cost, and the returns. And again, just from last night's numbers, market's definitely, making some different calls
Sifting through winners and losers.
Yep, absolutely. So again, Meta down 10%, Google up 5-6% here. Some winners and losers is what the market's looking for here. S&P pretty much unchanged on the day. The Dow's up 470 points, and Nasdaq, thank you, Meta, is down 154 points. So not a lot of direction here. Gold, it's higher.
markets, headlines, and breaking news 24 hours a day at Bloomberg.com, Bloomberg Television, and the Bloomberg Business app. This is a Bloomberg Business Flash.
From the Bloomberg Interactive Broker Studio, I'm Alexis Christoforous. The S&P 500 is little changed as oil prices pull back from their 4-year high. Still, the S&P is about to close the book on its best monthly gain in more than 5 years. Right now, S&P 500 up about 3.5 points. Dow Jones Industrial Average, though, racing ahead 546 points, but the Nasdaq Composite is down 127. Brent crude is at 114.52 the barrel, down about 3%, while we've got West Texas Intermediate down 1.5% at 105.25 the barrel. As for some stocks on the move today, Ford slipping more than 3%. The automaker raising full-year profit outlook due to demand for high-margin pickups and SUVs, but it's warning of pressure from an unexpected rise in commodity costs. Shares of Royal Caribbean up 7.5%. The cruise company's forecast for full-year earnings was better than some analysts feared. Also, Royal Caribbean says it's seeing a rebound in bookings for the Mediterranean that were initially hurt by the Iran war. And Chipotle is starting to win back customers. Sales rose 0.5% last quarter, helped by the popularity of its chicken al pastor and extra servings of protein. Shares of Chipotle up more than 3%. And we've got Apple up about 0.5% ahead of its earnings report due out after the closing bell. For on-demand news 24 hours a day, subscribe to Bloomberg News Now wherever you get your podcasts. I'm Alexis Christoforous. That's a Bloomberg Business Flash. Paul and Scarlett.
All right, very good, Alexis. We appreciate that. Scarlett Fu and Paul Sweeney live here in our Bloomberg Interactive Broker Studio in New York, streaming live on YouTube as well. Wild trading in oil. We've got Brent crude down about $3.80 here to 114. Last night, it got up to 126, the highest level in 4 years. So it's just been crazy in the oil markets here. Mike McGlone joins us here, senior commodity strategist at Bloomberg Intelligence. Mike, I don't know how you did it, dude. I mean, this oil is all over the place. How do you stay on top of this? And what do you think's happening here?
Oh, this is a dream market for a commodity guy like me, particularly because I'm not taking risk anymore, Paul. I kind of just say it with complete respect for all the doers that are listening. That's the hard part. But what you mentioned is Brent goes off the board today. So it's ran through stops, it run through shorts. You got to 126. It's probably putting a pretty good peak. I still think crude oil's his peak for the year and maybe for a long dated time. Look at WTI. The high still remains 120 back from March. And what's happening here is landman's loving this because prices right now on the front almost double their cost of production. So the key thing is so far, we're seeing demand destruction in the rest of the world. The thing is we're not seeing wealth reversion yet in the U.S. stock market. That's wonderful. The key thing to remember in the big picture is we've never had surging volatility like this in crude oil and gold without it trickling up to the stock market. So far, it's been different. Let's see how long that can last.
Yeah, there's also some technical factors at work here, too, with the front futures contract headed for expiry. What does that say, Mike, about how people are positioned for oil? I mean, they know that in the near term, it's going to be elevated, even as many are convinced, as you've pointed out several times, that oil will likely fall as we get towards the end of the year because of the midterm elections and President Trump wanting oil to come down.
Yes, people know that. And that's one thing about crude oil traders. They're all seasoned. They know the higher it goes, typically the harder it falls. Now, natural gas taught us that in Q1. It was up 100% on the year. Now it's down 30%. Now that's a front futures contract. But Scarlett, you mentioned it right. The key thing in futures, you look at the managed money net positions, was basically speculators and hedge funds. They are long. They're long about, in terms of all petroleum futures, about the most in 2 or 3 years. They should be. Markets are going up, but they'll be the first ones to get stopped out and sell on the way down. It's not just crude oil futures, though. It's also in the grains. And grains are important, corn and soybeans, because that means biofuels. And that's a key area they're looking for demand. The key thing there is this is typically the month of the year that they put in peaks. So you have to be hoping it's different. Positions are long, but the thing is looking out forward in the curve. They're much lower because those producers are selling forward, which means the supply is going to be coming on big.
Gasoline in California top $6 a barrel, $6 a gallon. I mean, that's hitting people in the pocketbooks here. And, you know, obviously they've got their own taxation issues out there as it relates to the gas. But does gas trade just in line with oil, or is there other stuff going on for the price of gas?
Well, California is unique. I think the average price is around $4.30. The all-time high was $5 in 2022. Now, that didn't really hurt things too bad, but you're pointing out, Paul, what's really going to be a problem hitting that. It happened so fast. capital budgeting decisions, hurting consumers, most notably diesel. The question is, where does it go from here? And I fully expect, well, Mr. Trump needs that lowered by the midterms. We're getting to the summer blending season, which means it'll stay high. But by the time we get midterms, I still think that December crude oil future will be down closer to 50, which means gas below 3. It's a question when it happens. The key thing to think about, if gas stays high, the Republicans are going to get hurt in the elections. We'll see demand destruction. But the key theme for this whole thing is we're not seeing the trickle down in wealth destruction in the stock market, which is usually the first sign of demand destruction. That hasn't happened yet. If we can avoid that, that'd be wonderful. But to me, that's the key risk for the whole year, is that all this issue trickles to the stock market and then pulls everything lower.
Yeah, absolutely. One thing we should mention, I mean, in addition to the taxes issue in California, you also have the product supply different in California than everywhere else, right? Mike, there's no pipeline carrying fuels from the Gulf Coast into California.
Well, it's about time they learn the lessons of that. I guess they're all going electric. But that's an issue. I mean, I've lived in Connecticut for 3 decades, and we had a problem with pipelines from New York. It's usually a problem with heating oil. But hopefully that'll be solved. And I think that's what happens with events like this. It triggers people to realize, okay, we need to be secure with our energy. One thing it did in 2022 in the macro scale, it accelerated that trend of technology replacing fossil fuels. And this is going to accelerate EVs, I think, and solar panels and all that other stuff. And my EV, I'm very happy to drive it because I don't care about the gas price anymore. There's a lot of people like that.
All right. I mean,
that's saying a lot that our oil strategist drives an EV.
Exactly. Exactly. He was an early adopter, just like he was an early adopter from leaving the greater New York City area for Miami Beach back in the day. So smart guy all the way around.
He got ahead of Wall Street South.
Absolutely. He was there first. Mike McGlone covers all the commodity stuff for Bloomberg Intelligence, safely ensconced down there in Miami Beach. Let's go back to these markets again. The S&P unchanged on the day. The Dow's up 500 and the Nasdaq's down 140. So a lot of different disparity out there in the marketplace, driven a lot by earnings right now. Ann Maletti, head of equity investments at Allspring Global Investments, joins us here from Milwaukee via Zoom. Hey, Ann, what are the conversations you're having with your portfolio managers these days? Because there's been a lot of volatility, markets selling off at the beginning of the war and then snapping back even more quickly and setting all-time highs. What are the conversations you're having with your PMs?
Yeah, Paul, it's a great question. And thanks for having me on, Scarlett and Paul. I think our PMs are very, very focused on trying to take emotion out of decision-making because it's really difficult in volatile times. So they're working really hard, but they are looking at not only what has performed, but what hasn't, and areas of the market that they're still very comfortable with, despite all the questions about the future.
Lots of questions about the future. How much is earnings season answering some of those questions? Or in some cases, is it just kind of pushing off the questions? I mean, we didn't get very much precision in answers from, say, Mark Zuckerberg of Meta.
I think earnings season is really important, not so much for what the companies have produced in the prior quarter, although, surprisingly strong numbers, earnings are going up, multiples are still coming down. That's a good place to be. But it gives us a little bit more picture around what the CEOs and CFOs are focused on going out in the year. And again, most of the trends are positive, really highlighting the strength of the economy. And so a lot of attention being paid to what CEOs and CFOs are doing to manage their business in the period of uncertainty. But we've seen really good resilience despite the volatility at most of the companies. I think we're at like 85% of companies beating expectations, and we're not seeing a lot of lowering of expectations.
So from the AI perspective, I think we're all learning this quarter by quarter by quarter, what AI means, how big it could be for the global economy, and then how to invest in it. It used to be in the early days just buy NVIDIA, but now there's so many other ways to play it. How are you guys thinking about really investing broadly across the AI theme?
Yeah, Paul, this is like a really important question because it gets us to what are the areas we're focused on that and want to be in relative to the AI play. Certainly, we believe in the innovation cycle, but we've been focused on how do you diversify away from just kind of the handful of names that have been the strong performers. So you want to participate in technology, but another area to play is industrials. And when I look at our teams, most of them have been overweight this area. Makes sense. It sits at the center of the CapEx spend in AI, but also the data center build out, the power generation that's needed, and also kind of has the theme of how do you adjust the marketplace for deglobalization or reglobalization. And so industrials have been an attractive area to play. I think even there, though, we're going to have to really focus on stock selection and those companies that can control their own destiny with the input costs potentially rising.
What about when it comes to small caps? There's a real divergence in the market just today with the Russell 2000 up 0.8% and the Nasdaq lower by 0.4%, largely because of Meta. You look at how things have shaped over the past year, and the Russell 2000 has outperformed the Nasdaq, for instance, by about 3 percentage points. Not a whole lot, but there is an outperformance there, which is notable given that it'd been a perennial laggard up until the last couple of years.
Yeah, Scarlett, I'm so glad you brought it up because small cap really has been one of the silent winners so far this year. Not having a lot of people talk about it, talk about that space, still some non-believers in small cap, but the returns year to date are double that of the S&P 500. And I think the reason for that is, we have seen diversification really start to play out. Investors looking for other areas of growth, not just within that technology space. And, when you look at earnings growth expectations, they continue to rise for the small cap space, again, looking better than even the general market. And so we're still a big believer that small cap is another way to diversify your portfolios.
How about U.S. versus rest of the world? And, we had a 2025 rest of the world really outperformed what was a good stock performance in the U.S. How are you thinking about that this year?
Yeah, Paul, I've spent most of my career in the U.S. markets. And so that's kind of been the area that I know the best. I still think the U.S. is set up well relatively to the rest of the world. However, investors really have ignored international and emerging markets. And EM was the quiet winner last year. People have paid attention to that, but there was a lot of doubt coming into 2026 that could continue. And we are seeing it continue. It's actually the best performing area of the market year to date, up around 14%. And so we still like EM. We believe that diversification is just as important as seeking alpha. And so trying to manage your risk through diversification makes a lot of sense. And we, again, are seeing good earnings growth as a good fundamental reason to be invested in EM, but also there's demand there for investors who haven't diversified outside of the U.S.
Gotcha. And thank you so much. It's always a pleasure speaking with you. Ann Maletti is Head of Equity Investments and Chief Diversity Officer over at Allspring Global Investments.
I was just looking at the Dow Jones Industrials up 590 points. I'm like, what's going on there? Caterpillar. That's what's driving. Of the 580 point gain, 520 points is coming from Caterpillar. That stock is up 9.6% today.
And this is a price weighted average, which is different from the S&P and the Nasdaq, which are weighted by market cap.
Yeah, so it's just interesting. So Caterpillar, it's good to see some of those industrial companies performing.
To Ann's point.
Yeah, performing well. So that's the play there. So there you go, folks. The Dow up 590 points. That's 1.2%. Thank you, Caterpillar. This is Bloomberg.
markets, headlines, and breaking news 24 hours a day at Bloomberg.com, Bloomberg Television, and the Bloomberg Business app. This is a Bloomberg Business Flash.
10:40 on Wall Street from the Bloomberg Interactive Brokers Studio. I'm Alexis Christoforous. We have got ourselves a mixed picture for stocks today as oil prices take a much-needed breather. The S&P 500 up about 4 points, on pace for its best monthly performance in 5 years. The Dow Jones Industrial Average, far and away the winner today, up 610 points, thanks in large part to a blowout earnings report from Caterpillar. But Nasdaq is down more than 160 points. Brent crude down about 3% now at 114.61 a barrel. West Texas Intermediate down 0.7% at 106.10 the barrel. And the Bloomberg Dollar Spot Index down 0.5% at 1195.16. Shares of Alphabet are soaring today after strong sales signaled its bets on AI are paying off. We've also got Microsoft losing ground. Some analysts say the pace of growth in its cloud computing business may have underwhelmed investors. And Amazon reversing an earlier gain despite the fastest quarterly sales growth for its cloud unit in more than 3 years. And I want to call out Qualcomm. That stock is up about 14%. The company is entering the lucrative data center market and working with a leader hyperscaler to provide custom chips. For on-demand news 24 hours a day, subscribe to Bloomberg News Now wherever you get your podcasts. I'm Alexis Christoforous, and that's your Bloomberg Business Flash. Paul and Scarlett.
All right. Thank you so much, Alexis Christoforous. You mentioned some of the big earnings. Meta and Microsoft are big drags on the Nasdaq 100, while you have Alphabet going off basically to the moon right now because it's seen as the winner and it's seen as the most efficient user of CapEx. It's been able to turn around investments and returns on that CapEx. Let's bring in Anurag Rana of Bloomberg Intelligence. He is our tech analyst joining us from Chicago. Anurag, walk us through the results from Microsoft, first of all. Alexis mentioned how the cloud business saw good growth, but perhaps not good enough for investors.
Again, it's a question of relative growth compared to their peers. So for Microsoft, growth accelerated 1 percentage points from 38% to 39% in constant currency. But when you look at Google, it went from 48% to 63%. So I think it's a relative game. Even in the case of Amazon Web Services, last quarter they grew at 24%, this quarter 28%. So we are really splitting hairs, but I think that's what's really happening at this point.
There's no scenario where Microsoft's not a huge winner in AI. Is there, Anurag?
No, absolutely. You're right about it. But again, it's a matter of one of the things we discussed even yesterday was if you go back in the history of Microsoft, they were the first company to showcase AI revenue, and they saw a lot of benefit for that 1.5 years when everybody thought Amazon and Google is behind. Now it's slightly on the other side. They are seeing the benefit of AI, which they didn't see, which means relative growth rates are higher for them. But in the case of Microsoft, they have a very successful AI business. Their AI run rate is much higher than anybody at this point. They have Copilot adoption, very fast pace. Azure's doing well. And the funny thing is, Azure is now a $100+ billion business. I think we think it's somewhere around 110 billion, growing at 40%. I mean, I think that's very impressive. But again, it's a question of if Google can beat by such a big margin, well, why couldn't you?
I'm glad you bring up Copilot because isn't there some concern that there's only a small percentage of Microsoft Office users who are paying for Copilot AI tools? I mean, everyone has access to it, but not everyone wants to pay for it.
That is the biggest growth opportunity for them, frankly. If you see, they have about 400+ million users. Out of those 400 million users, we think about 200 of them are power users, people like you and Paul. And then within that cohort, only 20 million of them are paying right now. So the penetration rate is, let's say, about 10%. Over time, that's going to increase, and that's where the ARPU increase is going to be, and see a much rapid growth rate, both in terms of the number of users going up, and then taking up dollars along with it.
So get them hooked first, right, Paul?
Yep. Yes. This is a milestone day for the AI universe. You know why?
Why?
I downloaded the ChatGPT app today.
For the first time ever.
First time
What was your first question to ChatGPT?
Well, Sarah Livesey, one of our producers, showed me. She went in and said, hey, give me a picture of traders looking for direction. in the market. And it gave her like a great image. So I did the same thing, and it wasn't as good an image, but it was a pretty good image. So Sarah's much better than I am.
You got to work on your palm skills.
First thing I'm getting there. Anurag, how about Amazon here? Their cloud, that business seems to be big, and again, another one of these companies throwing a lot of money at this business.
Now, Amazon Web Services, over $150 billion run rate business, grew 28%. We think that rate of growth actually improves in the next few quarters because of the massive backlog. Imagine, just a few days ago, they added OpenAI models into their entire ecosystem, which they didn't have access to before. That's going to spur even more enterprise AI adoption. One of the things people don't realize is when it comes to Fortune 2000, who are the biggest spenders of money, bulk of their data is in Amazon Web Services. That's all the cloud transition that's been happening for the last 15, 20 years. So they are actually at the center of this agentic shift for enterprises going from, the legacy way of doing stuff towards agents.
Anurag, as we look ahead to Apple, it'll be one of the last of the Mag 7s to report. We also have NVIDIA, but they kind of report on a different earnings calendar than everyone else. What will you be listening for from Apple? Do the numbers even matter this time around, or is it all about trying to understand how the incoming CEO, John Ternus, will be positioning the company?
See, I personally am more interested in how they're going to upgrade Siri and infuse more AI into the way we do things. Paul just gave an example that he downloaded ChatGPT. I think over the next 2 years, he won't have to do that. He would actually just have to ask Siri and say, do this for me, but use OpenAI. Do this for me, but use Gemini along with it. And I think that integration is far more important for Apple today because I think they have not been as far ahead in the AI curve as some of the others.
I do have Siri in my new car.
Have you interacted with Siri?
It's 70 miles an hour going down the Garden State Parkway, which might not be the best place to try it out. But talk to us about, do we need a big revolutionary AI announcement from Apple? And if we do, when are we going to get that?
So it's not going to be revolutionary. On June 8th, we will get the first day of the Worldwide Developer Conference. On that day, and Mark Gurman's done an amazing job in reporting this to us, Apple's going to introduce the new Siri, where at least on the Siri, they're going to be using Gemini models at the bottom of it to drive that technology. But it will also allow us as users to basically tap into any of the AI apps that we have downloaded on our phone, and most likely we have a premium package around it. So that integration is extremely important. Paul, one of the things I have been doing a lot while driving is to actually just start Gemini or ChatGPT to discuss anything that I'm doing at that point. Either it's history or travel plans or anything, and the results are absolutely remarkable.
Interesting. You guys have interesting conversations when you're in the car. I'm not interacting with AI in the car, but that's just me. Anurag, very quickly here, when it comes to Apple and spending on Siri, has it already spent what it needs to, or is there going to be a ramp up in spending there?
No, we don't think any ramp up in spending. This is just part of their normal R&D. This is what's really shining bright about Apple. Their CapEx as a percentage of sale is about 3 to 4%, whereas in Microsoft, we are touching 40 to 45%.
Wow. That's a massive difference.
Are we going to hear from the new CEO today?
I actually don't know that. I doubt it, but I have no way of knowing that, frankly.
All right. If I were the board, I'd be like, we made the announcement. Let's go.
Well, he doesn't take the reins until September 1st.
September 1st, yeah.
Yep, that's your point.
And right now he's a hardware guy, and they do have some hardware releases that are coming up. This foldable phone. I don't know what you think of that. Don't do that when you're in the car, by the way.
No. I'm doing a hands-free. I want to see. I'll go check out. I'm sure we've got on the Bloomberg terminal what the dude's new compensation package is.
Oh yeah.
We got to start that dude on the path to some.
I'm sure he's covered well.
So I'm sure that's out there in 8K. We'll check that out. Anurag Rana, thanks so much. We appreciate it. Anurag Rana, technology analyst, Bloomberg Intelligence. He and Mandeep Singh, they kind of lead our global tech effort, and we are all the better for it. That's for sure. S&P, actually just look at Apple. Apple's up 0.3% today, pre-market, kind of before this. But the stock year to date for Apple's absolutely flat. Over the trailing 12 months, it is up 27%. So it's had some good performance over the last year. And it gives it that market cap, which I just love, $4 trillion.
Ho hum. I mean, it's actually more expensive than it's been over the last 10 years. The Forward earnings is about 30 times.
Yep.
So S&P 30 versus a 10-year average of 23.
Oh.
Because the growth has been slower than the rest of big tech.
Yep. All right. So we'll keep an eye on that. Apple after the close. Carol and Tim Stenovic, they'll bring that to you this evening.
This is Bloomberg Intelligence with Scarlett Fu and Paul Sweeney on Bloomberg Radio.
Scarlett Fu, Paul Sweeney back in our Bloomberg Interactive Broker Studio in New York City, streaming live on YouTube. We got some video up for those of you on YouTube. The King and Queen of England, they are back in Washington, D.C. They're at the White House. They're now standing with the President and the First Lady. And I think they've got a little bit of a schedule, some of events in Virginia before they head back to...
This is the official farewell. So they're going to take care of that, say goodbye to the president and the first lady, their hosts. And they're going to move on to the diplomatic reception room. That's where they're headed to do just that. And then afterwards, they're going to head over to Virginia, the town of Front Royal, which, like America, was founded a quarter millennium ago. So the royal couple, the king and the queen, will help the residents of that town. There's about 16,000 people who live there, celebrate their anniversary.
All right, very good. I mean, I would think by all intents and purposes, this has been a very successful trip for the royal couple. What I understand was, very well received speech at Congress, and then the state dinner as well.
The state dinner delighted the president, and I almost called him Prince Charles because I'm a child of the 80s. But, clearly he charmed the president and, kind of smoothed the waters maybe between the U.S. and the UK going forward.
I don't know. I've always been, and I'll always be, a fan of the royal family. I love the whole monarchy thing. So I know
Did you
some
watch The
people
Crown?
don't. I did. Awesome.
And a fan?
Awesome. Big time fan. But I know some people aren't. But anyway, I
think the early seasons were better than the latter seasons.
True with most shows, probably. You get a little tired there. Speaking of London, let's head over to London. Sam Fazeli, Director of Research for Global Industries, Senior Pharma Analyst. I have no idea where he is. He could be London, could be anywhere in the world. That's how this guy rolls. But he covers all the pharma for Bloomberg Intelligence. Sam, I assume you and your team have been kind of busy here. We've got some earnings coming out of the pharma companies here. Eli Lilly raising its annual sales and profit forecast to high demand for obesity medication. Boy, that's just like perfect for this market. The stock's up 9% today. What did you hear from Lilly?
Yeah, so Paul, I mean, the interesting thing here is that there's been quite a lot of skepticism, particularly everybody was so focused on this oral drug, the pill that they've got launched in the US.
Yep.
So focused on that and tracking the weekly prescriptions that they forgot actually there's an enormous juggernaut of a business behind it. And what's driven this $2 billion increase from 80 to 82 on the low side of the guidance for 2026 in sales is ex-US sales. So that's actually quite good because a lot of people always just keep thinking that everything is all US based and everything's going to be driven by US. But of course here we've got that increase and that's what's driving it. High quality beat, 9%, 9.1% up this minute.
All right, so good news for those who are investors in Eli Lilly. That's a massive move, 9% up for the company.
Yeah. It had been suffering, Scarlett, because of the issues of people worrying about that pill.
So maybe a little bit of catch up there as well. Merck also reported results and it beat its sales estimates. Demand for newer drugs. Remind me, does Merck have a weight loss drug on the market or is it developing any weight loss drug?
They are developing. They're developing one, yes. I think everybody is they've got one that they've in-licensed. Pretty much everybody's got their finger in that pie. I can't say absolutely everybody. Most people have got their finger in the pie trying to get something on the market, and Roche, AstraZeneca, and time will tell whether they can compete in this. Clearly, these guys are sewing up the market between themselves and Novo Nordisk. So Merck's results were a little bit more, I would say, meh. And as the share price suggested, 0.6% up. There was a beat, but then, of course, much of that was driven by inventory build, which is not something that the market gets too excited by because it's one-off. And then, of course, one of the reasons I think they've been able to guide to a higher EPS is because they're going to have lower charges associated with an M&A deal they've done, and that's not really, that's not a high-quality beat. So business. Steady as she goes.
Merck, based in Rahway, New Jersey. Station stop Rahway. There you go. That's how I know Rahway. Station stop Rahway. Like I never get off. That's where Merck is.
Jersey is big pharma land. Let's face it.
Jersey. You could just have that's the entire state, practically. Merck. So Sam, for these oral obesity drugs, to what degree do you think that's going to expand the market?
Yeah. So I think look at analyst expectations. Folks are looking for $1.5 billion from a Lilly's pill this year. Wow. And it's only been on the market for a couple of weeks, 2 or 3 weeks, right? So, and that might be a tough number to get to, especially listening to what the management were saying a little bit about the fact that they need to activate a whole bunch of patients, etc. And there is a question that comes to mind. We know that the Wegovy pill, although it's a bit more of a cumbersome thing, you have to take it half an hour before eating breakfast, etc. It gives you a better weight loss in terms of the average weight loss, say 14% versus 12. Let's say that's about the delta between them. And so what are you going to do? Are you going to worry so much about your pre-breakfast? I mean, not nobody gets up and straight away, right? So they're going to take their jab, potentially shower, get ready, etc. So maybe it's a bit more likely that people will continue on that, and that Lilly will have a tough time gaining momentum with its oral pill, which is an oral pill, literally an oral pill. You just pop it, nothing to do with fasting or anything. And then, of course, you go to 2030, you get to $20 billion. So, look, they have the better obesity injection today in terms of efficacy. Novo has the better pill in terms of efficacy. So it's just going to be, both of them are going to be fighting for that market share. And Novo's kind of corrected quite a lot, right?
All right, Sam. Good stuff as always. Sam bringing it. Sam Piselli covers all the pharma for Bloomberg Intelligence in London. For our listeners in the U.S., a reminder, you can listen to us via satellite radio at Sirius XM Channel 121. Access the world's only global audio business network, coast to coast, 24 hours a day. Bloomberg Radio and Sirius XM Channel 121 is presented by Golden Crest Metals. Stay tuned for the latest market news and industry research. The next hour of Bloomberg Intelligence starts right now.
This is Bloomberg Intelligence with Scarlett Fu and Paul Sweeney.
Concerned about rising prices spooking investors.
What does renewables investment look like in the U.S.?
More tariff talk coming out of this administration.
Breaking market headlines and corporate news from across the globe.
The president wants lower interest rates. He wants a rate cut cycle.
How do you broaden out the AI play?
Are people just looking for something to worry about when it comes to China?
Bloomberg Intelligence with Scarlett Fu and Paul Sweeney on Bloomberg Radio, originals and the Bloomberg Business app.
This is Bloomberg Intelligence from the Bloomberg Interactive Broker Studio. You are watching live pictures right now of the president and King Charles shaking hands as the royal couple get ready to depart the White House. This was the official goodbye ceremony. They held it in the diplomatic reception room, and it's the end of the 4-day trip the King and the Queen of the UK have made to the United States.
Spent some time in Washington, D.C., and then yesterday spent some time in New York. I think most notably for many New Yorkers that the King and Queen went to Ground Zero Memorial at the 9/11 Memorial downtown, which is a spectacular memorial. And it's a great, memorial to the folks of 9/11. And they had a ceremony there, which is nice.
And they're going to head over to Arlington Cemetery as well to lay a wreath. But first, they're going to stop by the town of Front Royal in Virginia, which, like the country itself, the United States, was founded a quarter millennium ago, so 250 years ago. So the royal couple will help the residents of that town celebrate their anniversary as they wrap up their 4-day trip to the United States. Of course, the goal of is to celebrate 250 years of U.S. independence, but also, on the backside, maybe smooth over relations that have been ruffled with the United States between the UK and the U.S.
Yeah, and there's a lot of Civil War and Revolutionary War history in that Virginia area.
Yeah,
it's
definitely.
Great
Maybe
stuff.
they'll go to Colonial Williamsburg. Who knows?
Yes. All right, very good. I think, let's say that we're going to go down to.
Oh, okay. Let's give you a taste of what's to come in
Very
this
good.
hour, because there's a lot going on today. There's a lot of earnings that we have to go through. There's big Apple results. There's a lot of central banks meeting. Christopher Cialino is our senior U.S. machinery analyst. He's going to talk to us about Caterpillar, which is boosting the Dow Industrials average by more than 1%.
Yep.
So big mover there. We're also going to check in with David Havens. He is our senior credit analyst on Blue Owl. Blue Owl has become kind of the poster child for private credit concerns. So we're going to talk a little bit about what's going on at that alternative investment firm. Andrew Graham, managing partner at Jackson Square Capital, will join us to give us his take on the public markets. And we're going to talk to Danielle DiMartino Booth. She's CEO and chief strategist at QI Research. You know her from her time at the Dallas Fed, to give us a recap of what we learned from Jay Powell and the Federal Reserve yesterday, and also to talk a little bit about the GDP data that we got this morning as well. A lot of data
in studio
on the U.S. economy. Danielle, always a pleasure to have her in studio. First, though, let's go over and get our Bloomberg Business Flash, and we're going to check in right now with Amy Morris in Washington.
All right. Thank you, Scarlett. Stocks rebounding on signs of economic resilience and solid corporate earnings. Oil retreated from their 4-year high. We do check markets for you all day long here at Bloomberg. The S&P 500 is up 0.4%. Nasdaq little changed on the upside. The Dow up 1.1%. The 10-year Treasury yield at 4.38%. The 2-year yield at 3.88%. WTI now closing in on $107 a barrel, and Brent crude has now topped $114 a barrel. I heard you just previewing your interview about Caterpillar coming up. Caterpillar has advanced now 8.5% since the open. It has hit an intraday record high. Economists at Morgan Stanley scrapping their forecast for Fed rate cuts this year after yesterday's hold. The team now says it expects 2 cuts, but those won't be coming until next year. Morgan Stanley chief U.S. equity strategist Mike Wilson says stocks can keep powering through with the rates where they are.
The market is doing a very good job of trying to digest all of these, different variables. But at the end of the day, as we focus on earnings, is always probably the most important variable, assuming that, the interest rate environment is stable. And I think that's where we are.
Hear our full conversation with Morgan Stanley's Mike Wilson on the Bloomberg Talks podcast. Economic growth in the U.S. accelerated at the start of the year, fueled by solid business and consumer demand. The economy grew at a 2% pace from January to March, recovering from the government shutdown, but the outlook is clouded by the Iran war. And Apple will report quarterly earnings after the close, investors looking for clues to incoming CEO John Ternus's strategic plans. For on-demand news 24 hours a day, subscribe to Bloomberg News Now wherever you get your podcasts. I'm Amy Morris. That's a Bloomberg Business Flash. Back to Bloomberg Intelligence with Scarlett Fu and Paul Sweeney.
All right, Amy Morris, thank you so much. We appreciate that. Scarlett Fu and Paul Sweeney live here in our Bloomberg Interactive Broker Studio, streaming live on YouTube as well. Green on the screen, as Amy just reported. Let's take a look at some of the stocks on the move today. We can do that with Bloomberg's Denitsa Sakova. Denitsa, what are you looking at today?
Everyone's talking about Magnificent Seven. Let's look at Meta, which is seeing a pretty negative reactions after the report. Shares plunged about 10%. Year to date, the drop is pretty bad as well. It's more than 8%. Ticker, of course, is Meta. The company raised its spending outlook yet again. The number everyone is looking at is their full year capital expenditure, which now they expect to be between 125 billion to 145 billion. This is for the whole year. I'm looking at the chart of how this has changed over time, and it's really a drastic change. Just in 2024, it was less than 40 billion. Now we're talking more than 150 billion. You can see the reaction from investors is obviously not so positive. Zuckerberg has said that his company will spend hundreds of billions of dollars on AI. Now we see memory chip shortage is triggering surging prices. Investors are getting worried. We saw similar thing from Amazon. We saw similar thing from Alphabet, but much more positive reaction. It seems like Meta has been on this strike where they increase capital expenditure. Investors sometimes are excited, but then they get wary that maybe they're behind on AI. And this is what's happening today.
I lost count of how many times you said the word billions because the numbers are so large. Let's talk about Ford.
Ford is also having a pretty rough day. They actually had a strong earnings report. The ticker, of course, is F. But Ford warned of pressure from an unexpected rise in commodity costs. We've seen a similar warning from General Motors. So clearly, this is affecting the whole industry, spooking investors. Despite the relatively strong reports, shares fell as much as 6%. Now some of those losses are being recouped, but nevertheless a negative reaction to the report. The good number was the company now expects to earn as much as 10.5 billion before interest. This is higher than their previous forecast. Ford refrained from raising their full year profit outlook. They said that the Iran war pushed up an energy and commodity price. So that's the big problem. There were some bright spots. They said their SUVs like Explorer and Expeditions are particularly strong. They're doing well. But in the end, we're all relying on commodity prices, even as some of the models are doing quite well.
All right, let's go. Eli Lilly, LLY is a ticker.
Yeah, weight loss drugs are doing great. Eli Lilly surprised Wall Street by raising its annual sales and profit forecast. There is obviously this rapid competition between Eli Lilly and Novo Nordisk, but now it seems like their fortunes are diverging a little bit. So what we're seeing from Eli Lilly, the stock is up 9%. This comes after demand for obesity medication soared and thousands of patients started taking its new weight loss pills. Of course, prices have been falling down, so there was a lot of tension whether this company will continue to soar to new highs. It's been under a lot of pressure since November. It's like 23%.
Right.
But now there is some new optimism. Interesting space to watch.
All right, good stuff. Thank you so much, Denitsa Sakova, our cross-asset reporter with our market movers. And Paul, I don't know if you've heard of this. There's something called Ozempic breath.
Yes, I had not heard of that.
Okay, well, apparently it is spelling opportunity for a company like Hershey's because what they've said is that GLP-1 drugs are helping to boost sales of mints and gum, including its icebreakers. Retail sales of the icebreakers line grew 8% last quarter.
No kidding.
Yeah, and I guess people want to snack,
effect.
right? But they don't want to necessarily eat something, like potato chips. So they're opting for mint or gum. And also Ozempic breath is basically burping because sometimes it's part of the side effects you get, like dry mouth, you get nausea.
Interesting.
All right. Part of the
Another play there. Very good. All right, let's get back to some of these earnings here. Caterpillar, some really strong numbers here. And when we want to talk all that big machinery stuff, we go to Chris Ciolino. He's at Bloomberg Intelligence, follows all those big engineering companies, construction companies. Chris, talk to us about Caterpillar here and their quarter.
Yeah, CAT continues to deliver against pretty lofty expectations with another top and bottom line beat this quarter. Really solid across the board, highlighted by better than expected performance in their construction business and sustained momentum in power and energy. But I think really more importantly here, their record backlog continues to grow significantly quarter over quarter. And management raised their long-term 2030 growth targets. They also announced that they're going to invest in some additional large engine capacity expansion. So the long-term visibility just continues to improve, which we think, should continue to drive these upward earnings cycle revisions.
And this is something that Matt Griffin of Bloomberg News has highlighted. He came on to talk to us about how Caterpillar was another way to play the AI boom. How much of this backlog and the growth that Caterpillar is seeing is directly tied to AI build out?
So it's a large portion, right? It's, now power and energy is approaching, roughly half the size of the business. But I think one of the takeaways I took from this quarter was that the backlog was really up across all businesses. And it's kind of at a unique time for Caterpillar in that not only do we have all these secular tailwinds on the power generation side, but now we're starting to see the cyclical tailwinds start to kick in terms of construction and mining. So all three businesses really starting to contribute to the overall enterprise.
And shares of Caterpillar today are up 8.8%, up 53% this year, up 184% on a trailing 12-month basis.
Wow.
52-week high, an all-time high for the stock. $880 a share. They need a 10-for-1 split badly, I think. So is this, because of the power business, Matt, when I think of, company like Caterpillar, I think of a cyclical business. Is this making this business less cyclical?
It may help mitigate some of the cyclicality. At the end of the day, I don't think it changes the underlying fundamentals of the business. This is still ultimately going to be a cyclical business over time. But you're certainly seeing that, the power and energy business, that backlog just continues to grow. So we have that additional production visibility, which has really helped, provide a little bit of a floor, at least during this downturn, as construction and mining were quite soft over the past few years. So, short answer, it helps mitigate it, but longer term, it's going to be a cyclical business.
Okay, I'm still kind of stunned by some of the numbers that Paul just rattled off. Who is Caterpillar's biggest competitor? Who picks up some of the slack that Caterpillar can't get to?
Yeah, as Paul alluded to, the numbers are quite staggering, and really, if you look at the valuation, it's quite hard to digest as well. But they continue to deliver and exceed expectations. It seems like quarter in and quarter out. In terms of competition, if you think about some of the more traditional equipment, particularly in the dirt or mining, it's Komatsu. They are the largest competitor to CAT, particularly on some of the equipment businesses. You also have Deere, who's trying to make bigger inroads into construction equipment. They're launching a whole new excavator lineup. And then there's a number of other regional players, the Hitachis, Volvos of the world. And then on the power gen side, it's pretty diverse. Where CAT plays, it still tends to be kind of at the smaller end of the spectrum.
Right.
So think, companies like Cummins, who also have the standby or backup power capacity.
Yep. All right, Chris, thanks so much. Really appreciate it. Chris Ciolino covers all the machinery companies, industrial companies for Bloomberg Intelligence. Red headline crossing the Bloomberg terminal here. ECB officials see June hike if energy prices don't ease first. So that's just kind of putting it out there.
Yeah, well, investors and traders had already priced in 2 rate hikes for this year. We're not moving in that direction in the U.S. yet. There's some discomfort among some policymakers that the next move would more likely be a cut. But there you have it, tightening because of rising oil prices. Obviously, Europe much more affected by rising oil prices than the U.S.
Got it. All right, F1. I saw the movie, but that's about my extent of the knowledge of Formula One racing. But it is big business on a global scale. And F1 comes to Miami this weekend, which means he had to send Matt Miller down to Miami because he's our car dude. He's our racing dude. Matt Miller, Open Interest co-host on Bloomberg Television and co-host of the Hot Pursuits podcast. He's down there in Miami. And Matt, just Formula One and Miami seem absolutely perfectly suited to one another. Talk to us about what's happening in Miami.
They are actually really perfect for each other. By the way, did you like the movie? Because I didn't love the film, even though I'm a huge fan of Brad Pitt and a huge fan of racing. I didn't think it was that great.
Well, I liked it because I'm not a fan, so I didn't know what was really accurate, not accurate. So I could see if you were a big fan and you'd say, "Hey, that's not really how it is," but it was good.
I would say, like, look, we've had 3 races already this year: Melbourne, China, and Japan. And I would say F1 was better than Melbourne, but not as good as China, and definitely not as good as Japan. The racing has gotten better and better and better in each successive venue, and now I expect Miami to be the best of the bunch, mainly because they've made some rule changes for this race. And at the beginning, it was too much of the electric boost, too much energy harvesting. So you'd have passes where one guy goes past the other and then he gets repassed and then he gets repassed and he gets repassed, and it felt very much like Mario Kart more than actual wheel-to-wheel, edge of your seat, like nail-biting racing. But they got it back a little bit in China and a lot better in Japan. Really, Ferrari has been the best to watch. Leclerc versus Hamilton have been great battles in the last 2 races. But they're going to reduce that boost to some extent. They're going to reduce the amount of energy that you can or have to harvest with these big electric motors and not such big batteries. And I think that's going to make the racing much better this weekend here in Miami. By the way, 275,000 people will be watching the race, probably more than 3 million people on TV. So it's a huge draw for Formula One, for Miami, a big win.
It's also a great people watching opportunity, Matt. Who is going to be attending the races, and who are you looking to speak with? Who are you looking to, rub elbows with?
I mean, for me, the most important people to watch and talk to will be the team principals and the drivers. So, for example, I just spent about 30 minutes here at Bloomberg House talking to Mattia Binotto. If you follow Formula One, you'll know he's now the team principal of Audi, but he's been with Ferrari for the last 30 years. He started out when Schumi did in 1991, working under John Todt. So he's a legend already. I was hoping to talk to Toto Wolff a little bit later tonight. I think he may have heard my commentary on the regulations, and so that interview is off. But I may get to sit down with Fernando Alonso, who is a legendary driver. He's done 2/3 of the Triple Crown. And he just actually had his first baby last month. So those are the people that I'm most interested in. I know there are famous people at the race. You're going to see probably a Brad Pitt here. You might see who else? Keanu Reeves. Maybe Joey from Friends. I know he's big into motorcycle racing, but I'm more interested in the drivers and the mechanics.
All right, Matt, great stuff. Enjoy it down there. There's nobody better for Bloomberg to be down there covering this than Matt Miller, Open Interest co-host on Bloomberg Television, co-host of the Hot Pursuits podcast with Hannah Elliott. They do some cool stuff, looking at all the cool cars around the world. So that's how he rolls. I'll be at the Jersey Shore.
headlines and breaking news 24 hours a day at Bloomberg.com, Bloomberg Television, and the Bloomberg Business app. This is a Bloomberg Business Flash.
It's 11:21 on Wall Street. I'm Amy Morris. This Bloomberg Business Flash is brought to you by Golden Crest Metals. Inflation, tariffs, and volatility have some investors turning to gold for stability. To get a free gold and silver info guide and learn how to add metals to your IRA or 401k tax and penalty free, go to goldencrestmetals.com/guide. That's goldencrestmetals.com/guide. Signs of economic strength fueled optimism about the outlook for corporate America, driving stocks toward their best month since 2020. We do check those markets for you all day long here at Bloomberg. The S&P 500 up 0.4%. Nasdaq up just about 0.1%. The Dow is up a little more than 1.1%. The 10-year Treasury yield at 4.38%. The 2-year yield at 3.89%. Oil prices starting to cool off a bit now after Brent touched a 4-year high, topping $126 a barrel. WTI now closing in on $105 a barrel. Brent crude now topping $114 a barrel. Applications for U.S. unemployment benefits plunged to the lowest level since 1969. The Labor Department reports initial claims fell to 189,000 for the past week, well below the 212,000 forecast in a Bloomberg survey of economists. Filings have remained subdued despite high-profile companies like Meta and Nike announcing job cuts, signaling the labor market continues to be in a low-firing environment. For on-demand news 24 hours a day, subscribe to Bloomberg News Now wherever you get your podcasts. I'm Amy Morris. That's a Bloomberg Business Flash. Let's get back to Bloomberg Intelligence with Scarlett Fu and Paul Sweeney.
All right, Amy Morris, thank you so much. We appreciate that. Scarlett Fu and Paul Sweeney live here in our Bloomberg Interactive Broker Studio, streaming live on YouTube as well. Blue Owl Capital. Fee-related earnings and assets increased as the alternative investment firm leaned on other parts of its business amid souring sentiment toward private credit. The market like it. Stocks up 14% here on those earnings. David Havens joins us, senior credit analyst, Bloomberg Intelligence, in our Bloomberg Interactive Broker Studio. David, talk to us about Blue Owl. Just give us the folks who don't really know what Blue Owl is. What did they do, and what did they tell you with their earnings?
Yeah, so Blue Owl is an alternative asset manager. It's a relatively new kid on the block in alternative credit and in private capital, primarily focused on credit, but it's got a varied ecosystem. Credit is about half the business. They're also involved in real estate and general partner stakes business. The principals of Blue Owl have been on the street a long time. They're very well known, and the principals have terrific reputations.
They have good reputations, but the company itself has kind of become a poster child for all the private credit concerns that have been hitting this market. How much of that is fair?
Yeah, so I think that there is a buildup of lack of a better term, fumes in the private credit world. Maybe it started off with a couple of high-profile bankruptcies last year. Jamie Dimon talking about cockroaches in the direct lending private credit world, which is somewhat ironic because many of these cockroaches happen to be on bank balance sheets rather than alternative asset management balance sheets, but cockroaches nonetheless. And then it just sort of continued to build. Then you had fear over AI's impact on software. Firms like Blue Owl tend to have a significant presence there. And the spark that sort of lit things on fire here was Blue Owl back in January was attempting to merge two of its entities together. That deal was scuttled. And in the process, they ended up selling some assets near par that they used to help redeem some of the capital for investors that wanted out. And that just sort of set off a bit of a firestorm.
Doug Ostrover, the co-founder. I know that guy from First Boston back in the day.
Mm-hmm.
Wow, good for him.
Yep.
So what's this stock to do? Is this just a company that's just got to put its head down, put up 3-4 quarters of solid earnings and then kind of earn its way back into the marketplace?
Yeah, I think it's telling that in the first quarter, despite all the sort of hand-wringing that went on, they managed to draw $11 billion of new capital in to support their funds. They had double-digit growth on a year-over-year basis, and I think that basically what they need to do is just go about their knitting. They're asset managers. And if they can continue to put up good numbers, which they've been doing, generally double-digit returns in their funds above benchmark levels, then I think that investors will probably stay with them. I think that what we saw in the first quarter is maybe some of the hotter money, some of the investors, particularly in private BDCs, that may not have read their offering circulars.
It's right on the front page.
Or read it and don't care.
Yeah, or were texting while they were, while the risks were being explained. I think that they hit the panic button. By and large, most investors stuck with them.
Who are these investors who were seeking redemptions beyond the 5% that they're allowed to? I mean, what do we know about how sophisticated these investors are? Or were they just putting in the request just to see if they could get it?
Yeah, I think it's probably a fairly wide net. If you sort of think in terms of the gatekeepers here might be the financial advisors. They tend to be a little bit more sober. Some of the investors, which includes an international cadre of holders, I think may have been the first ones to sort of push the eject button here. But it's a wide range of generally high net worth individuals that are investing in non-publicly traded business development companies.
All right, David, thanks so much. Scott, I always feel like when David comes in studio, we're the only thing standing between him and a golf course. Like the first tee. David, thanks so much for joining us. Dave Haven, Senior Credit Analyst for Bloomberg Intelligence. Let's switch gears back to the market. Again, we got green on the screen here for sure, led by the Dow Jones Industrials. Thank you, Caterpillar. Andrew Graham joins us here, Managing Partner, Jackson Square Capital, based out there in San Francisco. So much like I stereotype people, guests from Texas, I ask them about oil. You're from San Francisco. I'm going to ask you about tech, just assuming you have a tech opinion. What did you take away from last night's earnings and all the huge CapEx increases and all that kind of stuff?
It's a fair question, and you're right. We have a lot of clients, of course, who are in the business and semiconductors and all the way down. So I thought it was right down the fairway. I thought that was sort of what we expected. There's sort of a turning point here, though, which maybe doesn't get recognized enough, which is that, when we started this whole AI journey, we talked about training a lot and GPU demand and so forth. And with all of this activity, you can see it, the backlog just between two companies, Microsoft and Google, is over $1 trillion. So we seem to be in more of an inference kind of phase here. And last week, we noted that both ARM Holdings and Intel mentioned at two different events that we're kicking off maybe a bigger inference phase where CPU demand is set to inflect higher.
We're definitely seeing investors distinguish between the different hyperscalers. Alphabet is kind of coming out on top, whether you look at performance this year, performance over the past 12 months. You look at today's trade, clearly investors not impressed with Meta. Does the market have it right now?
I think so. Google's got the whole stack, and they are hitting on all cylinders. Whatever, great. We could see that coming. It was a very popular long coming into the earnings print. So was Amazon. I think Microsoft was probably the one that was unloved, and there's reasons for that. Prices have been rising. Rental prices for GPUs and so forth have been rising over the last month and a half at a torrid pace. And I think that has to do with all the agentic activity that's going on with Claude Code and so forth. Going back to that ARM meeting, they estimate that agentic token burning is about 15 times that a human produces in inference. And so there's just a big surge in demand. And so Google is able to toggle their prices pretty well. Amazon even better. And then Microsoft less so. Microsoft has a history of concentrating on very large customers. These are more contractual, longer term type of obligations, so haven't been able to raise price, I think. But you can tell by their outlook that they are going to be able to take some price next quarter. So that's the way I saw it kind of line up. And one more thing just on the Amazon print. It seems like the big advantage of having your own custom silicon is starting to flow through as well.
You're out there in the Bay Area. I've been covering Silicon Valley for more than 30 years. And what I love about the Valley is, for better or worse, these people, they think that they can solve the world's problems through technology. Just don't worry about that.
Problem solvers.
They're like, Paul, don't worry about that. We'll come up with a solution for that. So when you've got one of those people come through the door, and you're stretching a portfolio for them. Are you trying to diversify them away from some technology, given that their whole world is driven by the technology and the valuation of technology? You try to diversify them away and say, hey, go buy some Caterpillar or something, go buy some soybeans?
Yeah, for sure. I mean, I think they know that coming in, that they're going to be getting a more of a broadly diverse portfolio. But yeah, we've people from private companies who are sort of lining up for this IPO cycle, OpenAI and so forth, who've come through the door, and it's great to have an opportunity to earn their business. And for the most part, they seem pretty humble, and which is nice. And they get it, they understand it. I think there's a lot of trust in the state type of angle going on here as well, because we're talking big numbers here in SpaceX and Anthropic.
There are so many of these, the SpaceX, maybe Anthropic, some
Yeah,
of those things.
some big
So
listings.
how does the Bay Area, the Valley, what's the chatter about that? Is there an expectation that there's going to be an explosion of personal wealth in that part of the world?
For sure. Yeah, and
Wow.
it's real
I
estate
hadn't thought about
values too. So in San Francisco,
Really?
yeah, and we had that conversation. I don't know, forget who I was talking to, but it's sort of like you may as well just buy it now and pay whatever they're asking, because the prices are likely going higher. In the fancy neighborhoods, like.
Are there a lot of people talking about moving out of California because of the sentiment against wealth right now? I mean, there's that proposal for a one-time billionaire's wealth tax.
Yeah. Bad idea, I think, in my opinion. But maybe they'll learn. Yes, absolutely. Everybody's got a plan B, including ourselves. And so we sit around as a team, where would we go? And throwing out all these ideas, Miami or all this stuff. We love it where we are. I mean, it's a beautiful area, and we wouldn't have the client base that we have without being located in San Francisco. So we're intent on staying. But things like that, and just, the congestion and traffic and just high state taxes in general are always, a little bit of sand in the shoe.
As I showed my son, who's now 30, back when he was about 12, we were skiing in Tahoe in the morning to snow over our head.
Mm-hmm.
The afternoon, he was with his on the beach with his grandparents in Carmel. Same day. You can't do
you
that.
can't get that anywhere else. Exactly.
And that's
a privilege, and maybe sometimes you have to pay for it. That would be the argument of those who support the tax.
Yeah. I've heard another one too. I had a friend who's snow skied in the morning, and in the afternoon he water skied on Lake Tahoe. The same day, which is kind of a fun. Yeah, it is. It's beautiful. It's nice. I would say, for me personally, I think San Francisco has been mismanaged for a long time, and they've got new management in town, and things are looking better. So I'm encouraged by that. And yeah, we're likely to stay in San Francisco, more likely to stay than not.
And I'll tell you what, my son goes to school in Santa Clara. Not a more beautiful place.
Yeah.
The weather's perfect.
I know.
I
Every day's
think it's
70
making him
mild.
soft. He's kind of, get back and go to school like in upstate New York or something. So, all right, bottom line, what's the best call for your clients right now?
I think the one that people are missing from this idea of, sort of inflection in CPU demand. So Intel just guessed that the mix of GPU to CPU is going to go from 8.1 to like 4.1. So we're going to add a new CPU server to every stack. And then ARM's talking about their 15x numbers and so forth. So Intel pushed out their 2026 double-digit CPU server growth forecast to 2027. If you do the same thing for Dell, which I think is fair, then you're adding another 25% earnings growth in 27, just like they have estimated in 26. And you've got a $17 earnings number in 2027. It implies the stock's trading at 12 times forward numbers. Easy stock to own. You get a dividend, HPE as well.
Right.
So it sounds like you think the government's ownership has been a good thing.
Yeah. For Intel, yes. Yeah. Absolutely helps.
My boy Frank Geary's the chairman of the board there, so that's a good thing for him. Andrew Graham, thank you so much. Appreciate that. Andrew Graham, managing partner, Jackson Square Capital. I put the two pieces together. That's San Francisco, folks. I'm a huge fan of San Francisco, always have been. When my friends from like overseas come to doing their 2 or 3 weeks in the US, I said, yeah, do the Grand Canyon, do all that kind of stuff. Do New York. Make sure you get a couple of days for the Bay Area. That's how good that part of the world is. We appreciate it. All right, earlier today, we had the Bank of England Governor Andrew Bailey sat down for an interview with BTV anchor Francine Lacqua. They discussed inflation and high energy prices stemming from the conflict in Iran. Bailey began his portion of the conversation discussing inflation expectations. Let's have a listen.
Well, inflation expectations have picked up. Now, of course, they do tend to follow the shorter end, 1 year ahead inflation expectations tend to sort of follow what inflation is today. But look, we're also obviously sensitive to the fact that people's memories are important here. They remember the fact that we had high inflation here 4 years ago. So that also has a part to play in this. And we do take it into consideration, obviously.
Governor, I mean, overall, the markets largely see today as dovish, yet your own chief economist was pushing quite hard for hikes. So is it odd having a dissenter coming from the BOE's own office?
Well, I wouldn't particularly say it's dovish, but obviously that judgment has to be relative to what what people thought we were going to do. So I respect that point. And we have been somewhat pushing against, I was pushing against the curve, as you know, 5 or 6 weeks ago, probably now. Look, I think Hugh Pill's position is perfectly understandable. I didn't vote with him. I didn't agree with him on the end decision, but I understand the point he's making. I would also say, and Hugh wrote this in his paragraph, that he used the word modest, and I think he used the word modest very deliberately. I mean, he'll speak for himself, but I think that word is deliberately in there. So the differences between us are not that big.
What would it take for you to actually to vote for a hike next time?
Well, I think we sit down and go through all the evidence, and I think what it will take is, and we laid out sort of some of the things we'd be looking at is both quantitative and qualitative. I mean, I think what we get on the qualitative side is going to be important because, we'll be talking to a lot of businesses saying, how are you approaching passing these cost increases through? What are you seeing in terms of demand for your, whatever you produce or provide? It's going to be some time before we get a real read on wage settlements because there's quite a seasonality to wage settlements in this country. And we've passed through peak season, which is earlier in the spring. So it's going to be a while before we get a really probably pretty big read on wage settlements. But we will be looking very carefully at what people are planning for. Those settlements that are coming through, that will be important as well.
How big is the risk of a technical recession at this point?
Well, most of the scenarios we have actually, and against most of the interest rate paths, actually suggest that this is a story of slower growth. In the more extreme sort of difficult scenario, with some policy, you can have a variety of policy responses. There are some quarters of negative growth, but this is actually interestingly not, as we see it today, at least, a story of dominating. It's going to be a recession. That's not the dominating story at all.
But Governor, I mean, so far you're happy with the market reaction, and also, I mean, next week is a big deal in terms of the elections in parts of the UK. Could that be a market event?
I think the market's reaction so far today is very sensible. Look, on the UK side, I don't comment on UK politics, obviously, but what I would say is this. The things that I think what we've seen in the interest rate curve has been dominated by the Gulf. The things I look for in terms of when I try to sort of break down what's influencing this, has the exchange rate moved? No, not much at all, actually. Have we seen much movement in short-run sterling swap spreads? No, not much at all. In fact, it's a bit tighter than it was before the budget last autumn. So that suggests it's really actually it's a Gulf story, I think.
Governor, I mean, the final question is the NISR warned this week that rates could go 150 basis points higher if the Middle East crisis worsened. I mean, can you see any scenario where that would happen?
Well, look, there are really bad scenarios in this. If we get cut off of energy supplies going on for a very long period of time, bad things can happen. But it's not in our in our central decision today at all.
But this is what, a 10% chance? So
I'm going to avoid it because I think that the world is so unpredictable at the moment. So we've seen it today, let alone over longer periods of time. The world is so unpredictable that I think putting sort of precise, percentage probabilities on things is put it politely, hazardous business.
That was Bank of England Governor Andrew Bailey speaking with Bloomberg Television anchor Francine Lacqua. Let's head over now to Washington and check in with Amy Morris and get a Bloomberg Business Flash.
Thank you very much, Scarlett. The Bloomberg Business Flash brought to you by Chapter. The average couple spends over $300,000 on healthcare in retirement. Want to know how much of that you can keep? Find out today in under 20 minutes with one free call to Chapter. Go to askchapter.org to get started. We do check markets for you all day long here at Bloomberg. The S&P 500 up 0.3%. Nasdaq little change now on the downside, and the Dow is up 1.3%. 10-year Treasury yield at 4.38%, and the 2-year yield at 3.88%. WTI now topping $104 a barrel. Brent crude near $114 a barrel. Eli Lilly getting a lift after raising its full-year outlook thanks to its weight loss drugs and hopes for a new obesity pill. Eli Lilly shares now more than 8% higher. For on-demand news 24 hours a day, subscribe to Bloomberg News Now wherever you get your podcasts. I'm Amy Morris. It's Bloomberg Business Flash. Let's get back to Bloomberg Intelligence with Scarlett Fu and Paul Sweeney.
All right, Amy Morris, thank you so much. We appreciate that. Scarlett Fu, Paul Sweeney, live here in our Bloomberg Interactive Broker Studio, streaming live on YouTube as well. I've been waiting for this conversation all day, because this person's not going to hold back. Danielle DiMartino Booth, CEO and Chief Strategist at QI Research. She joins us live here in our Bloomberg Interactive Broker Studio. We love talking to Danielle about economics and the Fed and where rates are going. She worked at the Dallas Fed for a long time, so she knows how that thing works. Jay Powell staying on as governor, to me, that was kind of
Not surprised at all.
Really?
Remember, he's Jay Powell Esquire.
Right.
And he wants to go into retirement peacefully and not with something hanging over his head that you could get a knock on the door.
Right.
And all of a sudden the investigation is reopened, criminal charges come back. He wants to go out clean and at peace. And I think that the last year of the escalation of the political wrangling has also made him rethink. I know Paul Volcker is my huge hero, but the guy on the name on the building, Eccles, stayed around after Truman got rid of him in 1948, after his 4-year term as chair ended, because Truman had the idea that the Treasury should be taking over monetary policy. And Eccles said, no, I think I'm going to stay on as governor and make sure that that doesn't happen. And he did. And he was very effective in doing that. So I don't think it's just this kind of weight of the potential criminal charges. I also feel like he thinks it's important for the long-term institution, for the independence of the Fed, which is a term that is so overused right now, but he knows that there is a certain political value of emptying that seat to be filled in this environment.
Right. By staying on as a governor, he deprives President Trump of the opportunity to fill another seat on the board and gain a majority.
Correct.
4 out of 7 seats. Right now, he would have 3 once Kevin Warsh becomes a member of the board. So the fact that Jay Powell says he will stay on indefinitely, does that mean when the criminal investigation has been completely cleared? Does that mean when the Lisa Cook ruling comes out? I mean, how do we figure out what that means?
I don't know. Again, I think we're just going to have to follow the political winds in the months that come. If things get even uglier than they already have been for the institution, then I think he stays on for the sake of staying on, for the sake of the country.
Because he's allowed to stay on until 2028.
January 2028.
So if we assume, and this is just assumption, that Mr. Warsh will have a dovish bias, and he'll certainly have political pressure from the president to cut rates, do you think Powell would see himself as a counterbalance to that, maybe?
You know what? I actually don't think so. He gave between 20 and 25 speeches when he was a governor. He was quiet as a mouse. He had no need for the financial media, did not yearn for the spotlight.
Okay.
This is Jay Powell.
This is Jay Powell. And he said in multiple ways yesterday, I am going to go back to being a deferential governor.
Okay.
It is imperative that Kevin Warsh be able to take on his position as leader and build a consensus on the Federal Market Committee and on the Federal Reserve Board.
But his actions indicate, I will not let this institution be politicized any more than it already has.
That is correct. Now, I will eat my words if we start to see Powell dissent coming out of the gate. Powell wanted to dissent in October 2012 when Ben Bernanke was insisting on another iteration of quantitative easing, but he didn't.
He was a deferential governor. He understood the value of a unified front. So his actions will speak for him. And if there are no dissents, and if he does let Kevin Warsh build the consensus. By the way, Powell agrees with Waller that there is serious risk to the labor market, to the low hire, low fire situation. He agrees with Christopher Waller that alternative measures of employment need to be added to the framework by which monetary policy is created. So I think that Jay Powell gets to go back a little bit to being more dovish than he's been, because he's not under political fire.
Gotcha. There's a deepening split on forward guidance. We know policymakers didn't do anything with the benchmark rate this time around, but 3 officials did not want any language pointing to future cuts in the policy statement.
Right.
Given the data that we got today, first quarter GDP, also the consumer spending number, more than expected, 1.6%, inflation up 0.7% versus the previous month. Were they justified in that positioning?
Possibly, but you have to focus right now on what's happening with core. And what's happening with the super core, which also nets out housing, energy, which Powell basically created. That is coming down. And it's coming down pretty quickly when you net out portfolio management fees, which is a producer price index input, which is basically a reflection of the stock market, not consumer demand. So services disinflation is becoming problematic because American households only have so much money to spend, right? We saw food at home print in the CPI at 0.0%. So gasoline went through the roof and US households spent less on groceries. So you have to pay attention to the core as well. And I've never been a big advocate of the core because we all have to pay for gasoline and we all have to pay for food, but you do have to be cognizant of depleting purchasing power on the part of U.S. households.
Danielle, thank you so much. We appreciate it. As always, Danielle DiMartino Booth, CEO and Chief Strategist at QI Research, joining us live here in our Bloomberg Interactive Broker Studio. Right now, let's join in progress a conversation. Cristiano Amon, Qualcomm CEO, speaking with Beat Tech anchors Caroline Hyde and Ed Ludlow. Let's take a listen.
It'll be 3 days after my birthday.
June the 24th, we've got to hold on to. But what does this signal about? You have been a man who's committed to telling the market that you are expanding the market. It's not just about mobile phones, where Qualcomm has really dominated the market share, but chips now in automobiles, in IoT, but really in the data center. What sort of TAM, what sort of expansion of Qualcomm's business will this mean for you?
Yeah, look, this is a great question. And I want to maybe start the answer by saying, why would not anybody, bet on Qualcomm diversification efforts? We started as a mobile company. If you look at what we're doing right now, we expanded into PC. We became one of the largest providers of semiconductor to automotive. We're going to industrial. We're going to robotics. We're going to broadband and networking. And I think the data center was a natural thing. We have been working on this for the past couple of years. We've been consistently saying we're building assets. We acquire companies like AlphaWave. We have a pretty good CPU, a very good accelerator. We're not a small company. We ship 40 billion chips. So I don't know why people would bet against Qualcomm, but I think it's okay. We're just been on this road to execution like we have done on the other business. And we're very exciting because I think what's really happening right now, as we enter this next phase of AI, we went from training to inference, now agents, which actually would generate demand for tokens. It provides an opportunity across the entire Qualcomm business. All of those devices where people are going to have agents running, whether it's phones and PCs, they're going to go to an upgrade cycle, and then some of the assets that we build create opportunity for data center.
Cristiano, specificity is so important here. You said, and you can correct me if I'm wrong, you said it was an ASIC product, which I think the market's looked at and is a little bit surprised. So you are not doing your own chip, you're not doing merchant silicon, your own designs for market, you're doing an ASIC with someone.
So we have said that our data center product, and I need to make sure I don't front run my investor day, but
I'm trying.
Our data, I understand that. My data center product offering includes 3 vectors. One is CPU, We're developing a CPU, and we're very flexible. We can provide a full SoC. We can provide chiplets. So that's one asset. The other asset is an accelerator. We have the accelerator with an innovative memory architecture. We don't need HBM for the disaggregated inference. The other one is the ability to do custom chip, which when we acquire AlphaWave, they have both a lot of IP, which is important for custom ASIC, as well as a custom chip team. When you put everything together, it creates a lot of opportunities for Qualcomm. Now, here's what is important to understand. The data center market is highly concentrated. There are about 6 to 8 companies that represent the majority of it. And what you see, what's happening in the market right now, a lot of solutions are becoming bespoke. They're no longer just merchant solutions. So I think as Qualcomm entered the space, you should expect that we will offer a lot of flexibility, and we'll leverage our supply chain and our design capability to do bespoke products. And I think that's what we're doing.
4 to 6 companies. That's interesting. So this depends on your definition of hyperscaler. Like, for example, Meta is not a cloud computing company, but it operates at hyperscale, its own data center infrastructure. So maybe that's what we're talking about here, the definition of what is or is not a hyperscaler.
Look, I'm just going to cut to the chase. We're talking about a large hyperscalers. You should be thinking about one of the large cloud companies that we have today. It's a scale business. So I think that's what we're talking about.
Ooh, getting closer. The potential customers, therefore, are 4 to 6, but they're huge. And maybe they're even more than that. So just, can you get specific about how big the opportunity is for this particular part of the business? How much you think it could ramp up revenue? So that's something you're able to push ahead of before the investment meeting.
Look, we don't get. I don't want to get ahead of our skis. We're executing. We're very pleased with the engagement, and what we said is it will be material in fiscal 27. Now, if you look at the scale of the Qualcomm revenue base, I think anything material to Qualcomm is probably in the multiple of $1 billion in fiscal 27. But look, we're just starting, and we're very happy with the progress we're making.
Cristiano, I think back very fondly to when you and I were on stage together at the Bloomberg Tech Summit. I think it was 3 years ago now. And we talked about the world where we switched to inference, running on device. But actually, Qualcomm's story has really changed in that time, right? So in this world where we're moving to inference and we're moving to agentic, how are you positioning Qualcomm, right? The CPU is important, but you must think differently to how you did 3 years ago.
Look, frankly, it's actually playing out exactly the way we thought. And I know we have a limited time, but when you start running agents and when you start running things like OpenClaw and a bunch of other claws, actually what is fascinating to see what's happening in the phone industry, every Android OEM right now is launching their own claw. And the way agents work, they actually operate your device for you. So what you're going to see at the end, you're going to see a lot of activity in the cloud, and you're going to see also activity on the device. And it's all going to magically work. I almost like to say this. I am sure you have probably 200 apps on your phone or close to that. We never have a discussion. We never have a discussion about how much each app is doing on the cloud or doing on the device. It just works. And I think that's how we see those agents working. They look at your data. They look at things on your device. They do things for you, and they do stuff on the cloud. And I think that's why I believe this actually builds into the Qualcomm assets and the fact that we're present everywhere. Our engagement with the cloud companies right now, they look at our devices at endpoints for AI. And that's also exciting. I think we're talking with all the AI companies about their new and exciting devices.
What's less exciting has been supply chain disruption, but you were really clear with investors and they liked it. Quickly, with 30 seconds. Memory, you see an endpoint, at least in China.
Yeah, look, the reality is everything needs memory, and AI drives more memory demand. They drove a lot of demand at the data center. It caused a crunch on the consumer electronics. The good thing is we now see the bottom. As I said in the call, we're under shipping market demand. We look at customer activations of devices and sell-through data. We see what the demand is. That's now we can call the bottom. And, you know, there's going to be more supply and more suppliers, and we'll see how this is going to play out.
The market is taking this really seriously. Qualcomm having its best day since April 2019. Qualcomm's Cristiano Amon. Thank you very much.
All right, that was Cristiano Amon, Qualcomm CEO, speaking with BTech anchors Caroline Hyde and Ed Ludlow. As Ed was just mentioning, Qualcomm stock, the company reported earnings. Market like what it saw. Stock is up about 17% here today. So certainly getting some of those tailwinds from AI that most of these tech companies are searching for. And features, and we're going to have Apple after the close tonight. That's going to be the big one today. Apple earnings after the close. Carol Master and Tim Stenovic will bring all that. They break that stuff down as it is reported. So that's good stuff. Last night, very busy. We had big four companies, Alphabet, Google, Meta, Amazon. You know, so we had some of the big players reporting numbers. The market's picking winners and losers here. Alphabet's Google is seeing a clear payoff from its AI spending with solid growth at its cloud computing unit and a, quote, meaningful acceleration in growth driven by demand for its AI software and infrastructure. That's it right there. And you're seeing that in the stock here. Stock of Alphabet is up 7% here today, 52-week high. On the other side, Meta Platforms is lagging behind, according to Bloomberg News, with its shares tumbling after the company boosted 4-year capital expenditures at it and its customer AI app being slower to take off compared to Google. So Meta stock down 9% today. Again, this is a company with a market cap of $1.55 trillion. So it's just extraordinary how the market's trying to discern winners and losers here. The four companies overall, including Amazon and Microsoft, are increasing their spending on AI with a total estimated spending of as much as $725 billion just for 2026. And investors are assessing how their interests are impacted by potential payoff of AI leadership. So there you go, folks. That is the story in tech right now. And it was a busy week. Yesterday with the big four tech companies, and now with Apple after the close here today. Again, it used to be just buy NVIDIA, buy the chip makers, and that was your AI play. Now investors are broadening out kind of as we get a greater understanding how AI is impacting not just the tech industry, but industries across the board here. And that's kind of what the market is right now. If you look at the market today, the S&P is up 34 points. The Dow Jones is up 730 points. That's due in large part to Caterpillar. They had some great numbers today. They called out artificial intelligence as a big source of their business growth there with the data centers and need for power. So that was interesting. Nasdaq up 41 points. So we get some green across the screen here. Oil still an issue here. We do have Brent crude down $3.95 at about $114. Brent crude last night traded as high as $126 per barrel. So really some concerns about the Strait of Hormuz, some strong rhetoric coming out of the leadership of Iran about the Strait. And that caused the oil to spike last night, early this morning. We've come back a little bit, and right now trading down just a little bit. WTI crude oil down about $2.85, right around $104 per barrel. So we'll keep an eye on that. Yields coming in today, 10-year Treasury yields in 3.7 basis points, 4.39% on your 10-year. So coming back a little bit, but again, a little bit higher than we were just a couple of weeks ago. For our listeners in the U.S., a reminder, you can listen to us via satellite radio on Sirius XM channel 122. Access the world's only global audio business network coast to coast 24 hours a day. Bloomberg Radio on Sirius XM channel 121 is presented by Golden Crest Metals. Stay tuned for the latest market news and industry research. Your top stories and global business headlines are coming up in just a moment. S&P up 34 points. The Dow up 700 points. That's 1.5%. And NASDAQ up 31 points. This is Bloomberg. Good morning.
From ABC News, I'm Michelle Franzen. The suspect in the assassination attempt on President Trump at the White House Correspondents' Dinner last weekend and back in court today for a detention hearing and will not be released.
Through his court-appointed attorneys, Cole Allen agreed not to contest his continued detention. But in court papers ahead of the hearing, the lawyer said there's no indication Allen hoped to carry out a mass shooting and that he in fact intended to minimize casualties by using buckshot in his shotgun. Federal prosecutors say the 31-year-old teacher planned an attack of unfathomable malice that risked the lives of hundreds of people and amounted to an anti-democratic act of political violence.
ABC's Stephen Portnoy. The war with Iran now hitting the 2-month mark, with talks still stalled and Iran's regime now threatening to hit back on U.S. aggression. Iran's new supreme leader, who has not been seen publicly since the war began, reportedly issuing a new message saying Iran will not give up its nuclear ambitions. That escalation driving crude prices higher and gas prices to new highs in the U.S. not seen in 4 years. ABC's Tom Sufi Burridge says the blockade by both the U.S. and Iran is impacting global costs.
The situation in the Strait of Hormuz remains. I mean, we are seeing a very small number of cargo vessels get through there. The Japanese said that one of their vessels got through yesterday. A Singapore-linked vessel, according to tracking data, also was allowed through by the Iranians and also by the U.S. through their blockades because it didn't breach the U.S. blockade. But, these are a very small number of vessels compared to what was, a critical, cargo point.
Despite the war, consumer spending remains robust. Government figures showing that the gross domestic product regained momentum in the first quarter of this year. After a historic visit this week, including addressing both chambers of Congress and a state dinner, King Charles and Queen Camilla wrapping up their trip, the royal couple making one last stop at the White House today and traveling to Virginia. You're listening to ABC News. After days of heavy rain, hail, and even tornadoes, flooding is the issue today for portions of the South. ABC News chief meteorologist Ginger Z has more.
Today, it's not about how severe, but it's about how much water falls. We've got flash flood threat that is elevated, a level 2 out of 4 from Hill Country today, and that includes Kerrville. San Antonio, the gateway to Hill Country, starts to get into it. Houston and College Station. Then as we go through tomorrow, this goes all the way over to Gulfport, Mississippi, Macomb, Mississippi, Alexandria, Louisiana.
Rainfall rates could be 1 to 3 inches per hour. Experts are warning about the safety of artificial intelligence after a tech CEO claims an AI tool wiped out all of his company's data in just 9 seconds.
The AI had deleted Pocket OS's entire production database. The company was able to restore the data, but only to the most recent backup from 3 months ago. It comes as experts raise the alarm about the growing power of AI. Earlier this month, Anthropic said one of its new models, Mythos, placed in a secure environment with no internet access, managed to break out. Elon Musk predicted that artificial intelligence would be smarter than humans as soon as next year.
ABC's Sophie Flay. The Apprentice may be making a comeback. The Wall Street Journal reporting Amazon is considering a reboot of the reality show. Instead of President Trump hosting the show, it could be hosted by Donald Trump Jr. Michelle Franzen, ABC News.
Live from Washington, D.C., this is Balance of Power with Joe Matthew.
FISA expires today, and there's no deal to expend the Spy Powers Act. Welcome to the Thursday edition. Easy for me to say as the House votes to extend FISA 702 in a bill that's already declared dead on arrival in the U.S. Senate. DHS still shut down. What do we do? Eric Wasson will join us coming up live from Capitol Hill. $6 a gallon gas has become reality for the first time in the United States. We'll look at rising prices from 2 different angles this hour when we talk to Bloomberg's Michael McKee on the economic impact, with Bloomberg's Ian Marlowe on the standoff with Iran, and with our political panel on fallout for the midterms. So we start, as always, on Wall Street. This market's taken off today. Amy Morris has the details for us here from Washington. Amy, what do you have?
Absolutely right. Stocks rebounding, oil retreating from a 4-year high. We do check markets for you all day long here at Bloomberg. The S&P 500 up 0.5%, Nasdaq up 0.1%. Look at the Dow up 1.5%. That's 731 points. The 10-year Treasury yield at 4.38% and the 2-year yield at 3.88%. WTI topping $104 a barrel and Brent crude near $114 a barrel. That's still high. Not as high as it was when it topped a 4-year high. Economists at Morgan Stanley have now scrapped their forecast for Fed rate cuts this year after yesterday's hold. The team now says it expects 2 cuts, just not until next year. Morgan Stanley chief U.S. equity strategist Mike Wilson says stocks can keep powering through with rates where they are.
The market is doing a very good job of trying to digest all of these, different variables. But at the end of the day, as we focus on earnings, as always, probably the most important variable, assuming that, the interest rate environment is stable. And I think that's where we are.
Hear our full conversation with Morgan Stanley's Mike Wilson on the Bloomberg Talks podcast. A key inflation measure jumped in March. Gas prices soaring. The latest sign the Iran war is pushing up the cost of living and delaying any interest rate cuts by the Fed. PCE rose 0.7% in March from February. That's up slightly from the month before. But compared with a year ago, prices are 3.5% higher. That is the biggest jump in about 3 years, putting the annual rate now at 3.2%. Economic growth in the U.S. accelerated at the start of the year, fueled by solid business and consumer demand. The economy grew at a 2% pace from January to March, recovering from the government shutdown, but the outlook is still clouded by the war. And Apple will report quarterly earnings after the close, with investors looking for clues to incoming CEO John Tremers's strategic plans. For on-demand news 24 hours a day, subscribe to Bloomberg News Now wherever you get your podcasts. I'm Amy Morris. That's a Bloomberg Business Flash. Let's go back to Balance of Power with Joe Matthew.
Amy, thank you so much. Amy Morris will be back in just about 15 minutes with more on the markets here as we keep up the good times on Wall Street. These are some big moves. Wow. Eli Lilly is up $83. Are you kidding me? Caterpillar up $81. Wouldn't want to be Mr. Softy today, I guess, but these earnings reports are bringing some serious volatility. And we're going to have a lot to unpack on the late edition. Next round includes none other than Apple, the 800-pound gorilla, and we'll see how it's behaving here throughout the day. Actually, there is some hope. Apple's up $2 right now, almost 1%. We'll see where we are after the bell. So thanks for joining us. You made it to Little Friday, the Thursday edition of Balance of Power here on Bloomberg Radio, satellite radio channel 121. If you're in the car and, of course, always streaming live on YouTube, check it out. Search Bloomberg Business News Live. You'll have a lot to see and hear today. And we're going to get to everything happening at the White House, $6 a gallon gas, the royal visit to Front Royal, Virginia. Yeah, that's happening today, too. But we want to start with the real news that's taken place on Capitol Hill, because they actually did something. Hold on a second. The House passed something. That in itself is a screaming headline. What did they do? They didn't reopen DHS. That's been closed now for 70-something days. FISA is what we're talking about here, and there's a lot of confusion about it. House members finally passing a 3-year FISA reauthorization. Here's the problem. It's coupled with language to permanently ban the Federal Reserve from issuing a digital currency. And so now we have a problem next door once again. The Senate says dead on arrival. That's the word from John Thune. Here's the other problem. FISA expires tonight. This is the warrantless spy program that Donald Trump says he's been the ultimate target of, and letting it expire in the middle of a war with a massive domestic terror threat is considered not too smart by a lot of people. And so there's a great question about whether they can get this done by the end of the day. This is where we start with Eric Wasson, who's live on Capitol Hill right now, Bloomberg News congressional reporter. How am I doing so far, Eric? Is there a chance they pull this out by midnight?
It's a fast-moving story, Joe, and I think trends are looking better in the last few minutes. We're seeing a real push here to pass the Senate DHS spending bill in the House on suspension. This would effectively end the 75-day DHS shutdown. I'm expecting that within hours. They're trying to button up a few members, but this would pass with Democrat and Republican votes overwhelmingly. It would fund everything but ICE and Border Patrol, which actually are already funded through the Trump tax bill, and are expecting even more funding, multi-year funding of $70 billion, through a budget reconciliation process. I'm also hearing a 45-day FISA extension. They're waiting on the Senate to clear that, perhaps unanimously, and vote on that as well. So things are trending better for Mike Johnson. It was a late night here in the House, a lot of battles over ethanol policy, holding up the passage of the budget, but he seems to maybe have the bus back on the road right now.
All right, fascinating. But so if the House version's dead on arrival in the Senate's about to jam the House with this 45-day extension. Will it be passed in the lower chamber?
I think it will be passed, but again, it's just more short-term can kicking by both parties, not resolving the central issue, which is about warrantless surveillance, under FISA. So they'll have another, month and a half to deal with this, but we could be right back here again because we just cannot really seem to assemble a coalition to pass a long-term, 3 or more year FISA extension.
It's like a recurring bad dream. DHS, meantime, you touched on this, 215, 211, after 5 hours of debate. You mentioned ethanol. The fact of the matter is they got this done before 11 o'clock at night. Where do we go from here? The Senate's got its version. What are the mechanics of this for it to get to the president's desk?
Well, I'm expecting the House to bring up a bill that will fund everything but ICE and Border Patrol through September 30th. You'll remember the Senate passed this weeks ago, but House conservatives said, no, we want to see progress on this budget, on this ability to funnel $70 billion to ICE and CBP in future years, basically to fund immigration raids through the rest of President Trump's term, taking all leverage away from Democrats to demand any change in ICE tactics. That has made progress. The bill itself has not received a vote, but the budget plan, this is the two-part budget reconciliation. That passage of the House was not guaranteed last night. There was some conservatives who wanted to see tax, spending cuts, other priorities, even the Save America voter ID bill put in there, but they've sort of been mollified by a push later this summer to do what's called Reconciliation 3.0, a larger bill with a grab bag of all the priorities. They've kind of bought into this idea, although I talked to people who are very skeptical, especially in the Senate, of that ever happening, and to just do this narrow bill now. So that passed, and now there's appears to be enough confidence to pass this Senate skinny bill. So it looks like I'm prepared to say the shutdown is over today if this passes the House unchanged and goes to the president's desk, because ICE and CBP are already funded. So we're not going to see a return to the airport chaos, which really loomed because we saw a memo from Russ Vought and the OMB sent to Congress this week saying, we can't continue to make payroll in May. We found a slush fund to pay TSA workers end of March through now, but that's not going to be the case. And we, as soon as the middle of May, we could see the return of that chaos. So I think the House is motivated to act. They're going on recess, both House and Senate, next week, and they really feel it's politically toxic to do that and let this potentially unfold at the airports while they're gone.
Man, I don't know how voters are supposed to follow any of this. I'm getting a popsicle headache listening to you walk through all of that. Maybe it just doesn't move. No, I mean, thank God there's somebody here to distill this. Eric Wasson, we haven't talked about a supplemental budget request in a long time for Iran. Is that coming? And I ask you that because Pete Hegseth he's back in a hearing today, committee hearing. It's just this grilling, the brutal hearing in the House side yesterday. He's getting it again today on the Senate side. Is he making the case for all this money?
He is making the case, but I will say we've looked at the defense stock investors. They're not bid up to the extent that you would expect from a request for $1.45 trillion in defense spending. I think investors are wise. We have done reporting this week. Pardon me. That shows
it's pollen
really no
season,
appetite. There's really no appetite for a $500 billion defense increase. Maybe 10% of that getting through Congress this year. So a big plus up. It's not really on the table.
Hey, Harvey, get Eric some water, man. This is brutal. I could hardly breathe coming in here. My car's green. It's just, that's what we're doing right now. Everyone thinks they're sick, but it's the allergies this time of year in Washington. Poor guy. You're right, though. The old line defense stocks have been struggling, Eric Wasson, and it's really interesting whether you're talking Raytheon or Lockheed. These charts are in trouble. Is that because a lot of the new money might also be going to some of these privately held defense contractors that make drones, autonomous vehicles for a lot less money?
I think there's a real sense of that. I talked to Ron Johnson from Wisconsin and others who basically say, what we're doing in Iran is throwing Ferraris at Frisbees. This is this idea that we're taking multi-million-dollar weapon systems and using it to shoot down cheap drones. So there's really going to be a question as to what we're spending our money on. Do we have to use these high price tag weapon systems And are they even looking at a larger, personnel footprint? Because if you expand the Army or the Marines, that's a multi-year cost. You're not talking about a one-year, $1.5 trillion defense budget. You're talking about defense budgets in perpetuity as those members get TRICARE and veterans benefits. So there's going to be some real scrutiny. Courtney McBride, a colleague who covers the Defense Department, I had a really good piece this week just about how this is getting a lot of pushback. This idea that they're going to ram through $500 billion before the election, I just don't see it.
All right. We're going to let you go, Eric. You powered through that like a pro. Eric Watson live on Capitol Hill. Love the bow tie. Get on YouTube. You would have seen it for yourself. Search Bloomberg Business News Live. Yeah, it's pollen season, right? If you're in New York, if you're in Boston, you know what I'm talking about. It's snowing pollen here in Washington, D.C., and everybody's calling in sick, probably because they have bad allergies. Although, I don't know, people are fighting stuff too. Just wait. It'll get better. In just a couple of weeks, it'll be 150 degrees in downtown Washington. The humidity will blanket us like we're swimming through water. It'll be worse than New Orleans. That's right around the time we'll have that UFC fight on the South Lawn and the F1 race, right, around the mall. That's also when the mosquitoes are going to get here. Cece pointed me to this story. The biters are back, says Axios. Another reason to come to the swamp. Mosquito season in the D.C. region typically takes off right around now, beginning of May. Experts say this year could be longer and buggier than usual. You thought Snow Crete killed the skeeters. Think again. We're in for a whopper, says the vice president of Mosquito Shield for the Washington region. Do you see that? Do you hear it? Blame moisture, a wet winter, plus erratic yet heavy spring rains equaling perfect breeding conditions when temperatures rise. Hey, it's a swamp, guys. If you want to come hang out here, pack your DEET. We turn to diplomacy and the impact that rising energy prices are having on everything from DEET to gasoline. $6. That's the new handle in California. First time ever? Did I read that? That all has to do with triple-digit oil, although prices are relaxing right now. Don't you worry, CC. They're going to let you fill in anytime you want. I'm Joe Matthew in Washington. Much more ahead. Only on...
It's 12:21 on Wall Street. I'm Amy Morris. Signs of economic strength fueled optimism about the outlook for corporate America. That drove stocks toward their best month since 2020, and it's still driving them. We check the markets for you all day long at Bloomberg. S&P 500 up 0.5%, Nasdaq up 0.25%, the Dow up 1.4%, the 10-year Treasury yield at 4.39%, the 2-year yield 3.88%. WTI now topping $104 a barrel. Brent crude climbing past 114. Meta rated the stock. The company looking to sell between $1 billion of investment grade bonds to boost spending on infrastructure for the AI intelligence boom. Meta is tapping the investment grade bond market only biggest ever corporate debt deals.
Much. We'll call it lucky. I guess